Hey guys, welcome to the Blueprint Trading course introduction video. This is going to give you a learning process overview. So for this introduction video, we're going to break it down into 5 parts. Part number 1 is I'm going to take you through the course structure. Part number 2, I'm going to explain the trader's journey. Part number 3 is building a trader's identity. Part number 4 is the difference between knowledge and skill set, which is deliberate practice. And then part number 5 is I'm going to take you through my chart setup. So let's start here. Part number 1, the course structure. So the question that I ask myself is, if I was to teach my daughter to trade, how would I go about doing that? How would I teach my own daughter to trade? How would I pass on to her all the information that I know about trading, all the knowledge, all the skill that I have? How would I pass that on to her in a logical format? So from A to Z, how would I do it? How would I kind of teach her? So that's what I'm trying to do in this video. Ideally, I'll show her this course, okay? By the end, I will then show her this course and then work through it with her. So what we're going to do is we're going to break it down into the 4 components of a trade, and we're going to combine other things like position sizing, portfolio construction within this as well. So we're going to start off section number 1, identify. How do we identify a high quality setup? Then number 2, how do we control the risk, create that asymmetric risk versus reward trading opportunity? Number 3, how do we mitigate the risk? How do we free roll the trade? Then number 4, what are the selling rules, selling guidelines that we are using to optimize the profits, both in terms of monetary gain, but efficiency of the monetary gain? So each week we're going to cover a new topic, and there's going to be a logical flow, as I said, from A to Z. So it's really going to flow through here, this course. So hopefully it's going to be really insightful, going to be very detailed. We can spend time on each of these. Sometimes if we have to spend a couple of weeks on a single topic, then absolutely we will do that. And if I feel like there needs to be a little bit more information on a certain area at the end of the course, we can always go back to that section and provide a little bit more information. So the way we're then going to do it in the live webinars and the live coaching is, for the first half of the session is going to be focused on me teaching, so about trigger bars, about shakeout demand tails, about entry order technique, so opening range breakouts, buy stop limit orders. Then in terms of the portfolio construction, I spent half an hour, 45 minutes on the types of stocks and position sizing. And then after that, for the remainder of the live coaching session, there's going to be a deliberate practice element specifically on the area that we were covering. Part number 2 is the trader's journey. So this is probably the journey that you'll go on as a trader. Now there's a fantastic quote by Bruce Lee, which is absorb what is useful, reject what is useless, add what is essentially your own. So that add what is essentially your own, you'll find that you'll start doing this. Okay, as you learn my systems and routines for identify, control, mitigate, and optimize, you'll start adding what is essentially your own. You'll start tweaking things, which is absolutely fine. I encourage that. I really encourage that. I think that's fantastic. Okay, take the information that you find is useful, take those golden nuggets, take the golden nuggets from other traders, from other books that you read, and then piece it all together and then combine something that really works for you, really suits your personality. There's a fantastic book by James Clear called Atomic Habits. I would recommend that you read it or listen to the audiobook. It's very good. And one of my favorite quotes from the book is, you do not rise to the level of your goals, you fall to the level of your systems. So this is what we're really going to focus on in this course: systems and routines, and how that fits into your daily structure. So this is going to be an emphasis on you as well for, okay, how do I build systems here, and then how does that fit in with my daily routine? All our daily routines are different, but by the end of the course you should be able to answer these questions. You should have it written down. So if I asked you, how do you identify a high quality setup? You should know. It should be really clear. If I then ask you, how do you control the risk to create asymmetric risk versus reward trading opportunities? You should know. You should have plans. You should have systems for how you're doing that. If I ask you, how do you mitigate risk on new entries that you take? You should know. Okay, you should have clear kind of tactics and strategies that you're implementing to mitigate risk. And then if I ask you, what are your selling rules? What are your selling guidelines that you are using to optimize the profits, both in terms of monetary gain but efficiency of the monetary gain? You should know. It should be written down. There shouldn't be any randomness here. You should know, okay, well, I'm looking to do A, B, C, D, and if this happens, then I do that. And we can then start talking as we start really going into the weeds during this course. As we really start going into the weeds and the nuance, we can then start thinking about, okay, subject to the type of market environment we find ourselves in, how do we tweak things, the tactics and the strategies from a systems level when we start going into specific parts. I don't want to get too ahead of myself here in the introduction video, but it's going to be very detailed. So it's understanding here with a trader's journey, okay? Successful trading is a process. A process is made up of systems and routines. Systems and routines are skill sets. So if they're skill sets are trainable. Deliberate practice improves skill-based activities. So you'll see that we'll do a lot of deliberate practice in every single session that we do. The final part, the second half, is going to be deliberate practice on the learning topic. I think deliberate practice is very, very important. You can improve at specific training aspects utilizing deliberate practice. So now let's go into the third part, which is going to be the identity. So as we start going through here and as we start progressing through the course, I really want you to identify as a trader. So you start making decisions as a trader. So you should know, okay, what am I doing here? There's no randomness here. What are you doing from a trader's perspective to identify a setup, to control the risk, to mitigate the risk, to optimize the profits? Again, from the James Clear Atomic Habits book, every action you take is a vote for the type of person you wish to become. So the type of trader you wish to become. So think about this. Every action you take, every trade that you take, every way that you manage is a vote for the type of trader you want to be. What type of trader do you want to be? As I said, we're going to go very deep here in terms of systems and routines, building your identity as a trader. No single instance will transform your beliefs, but as the votes build up, so as the decisions build up for how you're managing trades, the type of trades you're taking, so does the evidence of your new identity as a trader. So by the end of this video, really, hopefully you're embodying the qualities of a trader, making the types of decisions that you want to make as a trader. So but to become a trader, you must start thinking like one. So that's what we're going to do. We're going to start thinking as traders. Let's go into the fourth part, which is this here, which is understanding deliberate practice and the difference between knowledge and skill. So there's a fantastic quote by Bruce Lee. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. If there was a quote to sum up this course, this is going to be it. Okay, I fear the man who has practiced one kick 10,000 times. So I'm going to teach you what I think are the best setups. I'm going to teach you how I think is the best way to control risk, to mitigate the risk, to optimize the profits. This is about not doing things haphazard and doing things randomly, but trying to do the same thing every single time and get better at that thing. So very detailed, very specific in terms of what it is we are trying to do through the four components of a trade, from the identify, from the control, from the risk mitigation, from the optimizing profits. So understand, I'll let you guys read this out in your own time, but understand there is a difference between knowledge and skill. So what I want to do with this course, and again how I would teach my own daughter, is understand that there is a difference between knowledge and skill. So to improve your knowledge, you could watch YouTube videos, you could read books, you could watch seminars, courses like this, watching others. Okay, that's to watch it. Now, the Masters is kicking off in a couple of days' time, so I'm kind of using this analogy of a golfer, right? But let me just actually jump back over here, okay? The blueprint is designed to help increase your knowledge in 4 areas: identify, control, mitigate, and optimize. It will not increase your skill though. Only you can do this. So think logically about this and link it back to trading, okay? You could watch 50 hours of Tiger Woods playing golf. Your golf swing and handicap, being the skill part, is unlikely to improve. Would you agree like that? If you watch every minute of the Masters, okay, as it's on over the next kind of 4 days or so, if you watched every minute of the Masters, okay, let's say it's on TV for 10 hours a day, right, and there's going to be 4 days. So if you watch 40 hours of the Masters, and let's say your golf handicap is 10, do you think your golf handicap is going to go down to 9? Just from watching 40 hours of the Masters on TV? And you probably go, no. Your knowledge may go up in terms of, okay, Rory McIlroy plays a course like that, Bruce Koepka did that, he played the shot like that. Okay, your knowledge could go up in terms of thinking about tactics and how other people think about it, but in terms of your actual skill set, would it improve? Let's go a step further. You could read 100 books on swimming, but your swimming ability is unlikely to improve. Okay, you can't learn to swim reading a book. You've got to get in the pool. So what we're going to do is try and give you the knowledge of, okay, here's how I trade, here's how I think about it, but then we're going to bring in the skill side of things and utilize the concepts of deliberate practice. How to improve skill. So deliberate practice, in essence, is about becoming the player. So instead of just the watcher watching the Masters, becoming the player as well, becoming the trader, creating feedback loops, studying historical setups and annotating charts, bar by bar deliberate practice sessions, logging trades to analyze, actual trading and analyzing results plus decision making. Receiving feedback on your trading. So this is how we can actually improve. So yes, we want the knowledge, but we also want the skill set as well. So then let's just go into the final part. This here is just going to be an overview of my chart. So hopefully this video here is this video is self-explanatory, but also this chart here is self-explanatory. Hopefully you're very familiar with my charts and the layouts. Any questions, then please do just ask away on that. Ping me an email or via the platform. So I just want to finish this introduction with the Bruce Lee quote, because this is where I find that you guys go with your journey. Okay, absorb what is useful, reject what is useless, add what is essentially your own. And I get lots and lots of emails about, I was thinking about doing this, think about doing that, I did this. It's great. That's you along your trading journey. I find it fascinating just watching you guys go through your trading journeys, and when you start getting into what is essentially your own, it's really interesting, because that's where you start to see your personalities coming out. So absorb what is useful in this course, reject what is useless. You may not like some of the stuff, and that's absolutely fine. You may not like how I think about setups. You may not like how I think about risk mitigation. You may not want to mitigate the risk. You may find it very, very useful. So absorb that, use what is useful. You may find that optimizing profits and the selling rules, selling guidelines that I use are useless. Then reject them. It's absolutely fine. I'm not going to take any offense to it. And then add what is essentially your own. So add what is essentially your own into those 4 components. What is essentially your own in terms of the identify, in terms of the control, in terms of the risk mitigation, in terms of the optimizing, and then think about those systems through those 4 components and think about how that fits into your routine. So we're going to be talking later on in the course about how do these systems build into your routine, your daily routine as a trader. Now, all of our routines on a day-to-day basis are very, very different, but thinking about what are you doing when the market is open, what are you doing post-market, what are you doing pre-market, and how does everything fit together nicely. So I really hope you're going to enjoy this course. I think it's going to be very different to anything you have ever experienced before. It is going to be very full on. It's going to be very in depth. Hopefully it's going to be very interactive with the deliberate practice elements after the kind of structured teaching element. So thank you very much for watching the introduction, and I really hope you enjoy the Blueprint Trading course. Hey guys, hope you and your families are doing well. This is going to be the first video in a new course, which is going to be a pretty long course. There's going to be 30 something parts, probably maybe even 40 something parts by the time I add a couple more. But this is going to be identify 1.03 swing trading setups, and this is going to be the overview for this section. So what we're going to do in these Tuesday videos, we're going to add a little bit more structure to it. I appreciate it can sometimes be a little bit haphazard in terms of the kind of randomness of the topic. So what I wanted to do is add a little bit more structure to this. So this is what we are going to be working through. So as I said, this one here, this is going to be for section 1, identify. It's going to be an overview, and actually we're going to spend a lot of time on the price cycle. So the first half of the session is going to be kind of lesson and structure, and then the second part is going to be practicing it in a deliberate manner. So hopefully we're doing both the knowledge side of things, but also the skill set side of things as well. So then we're going to be flowing through. So then we'll go into trigger bars, check out demand tails, gap down, reverse bars, and then we'll go into section 1, identify, but then part 2, which will be the 3 types of stocks to trade. And that's how we're going to flow through in these Tuesday videos. So let's begin. Basically, yeah, if I make a couple of mistakes as we're going live, I apologize about that. There's quite a lot of information to try and articulate in a pretty concise manner, so I will give it a go. So this is going to be the overview. Okay, so we're just going to start off with the price cycle. This is basically the foundation. This underpins absolutely everything, and on the next slide I'm going to show you the Wyckoff price cycle, and then this is really going to be the topic of this video. So before we even start talking about in the upcoming videos trigger bars, check out demand tails, and gap down reverse bars, it's about having the context. It's about having the awareness of where do you think you are in the context of the 4 phases of the price cycle. So the way I wanted to say this a couple of minutes ago and I forgot, the way I'm basically structuring these courses is when Ella she's nearly 3 now. I don't know how she's nearly 3, but when Ella gets, I don't know, maybe like a year or another 2 years, and she already calls herself a trader root, which is pretty funny actually. She'll come here, she'll sit on this chair, and she'll do her own version of trading. But the way I was basically structuring this is thinking, how would I teach Ella to trade from A A to Z. Like, how would I actually lay it out and teach it? So this is basically how I would do it. So this is the first thing, okay? This underpins absolutely everything, which is the price cycle, which we'll come on to on the next slide. So I think this is a really, really, really useful study, okay? Pull up lots and lots and lots of different charts. Pull them up at the major indexes. Pull them up at the Dow Jones on the 12-month chart, which is a 1-year chart. So this is from the birth of the stock market to nearly present day, 2022. What do you see? What do you notice? Do this with the major indexes, do this with leading stocks from all sorts of different industry groups, different types as well. So pull it up for your Teslas, your Nvidias, your SMCIs, your Apples, your Microsofts, your Amazons of the world. Pull them up for the biotech stocks, pull them up for the oil and gas stocks, the Schlumbergers, the Exxon Mobiles of the world. What do you see? So this is what you're really trying to just ingrain inside your own head. What are the common characteristics I notice as stocks are basing in uptrends, topping, and in downtrends? So what do you tend to see on a consistent basis when a stock is basing, when a stock is in a good uptrend, when it is topping, when it's in downtrend? What are the common characteristics you see? Do specific things tend to happen before a stock breaks out of a continuation type base? Do specific things tend to happen around the lows of continuation bases? Do specific things tend to happen at the top of uptrends? So this can be kind of a climactic top. Don't worry, we're going to go into all of this. Do specific things tend to happen before downtrends? So what do you notice? So when you start deconstructing it and you think about the four phases of the price cycle, right? You have phase one accumulation, you have a phase two uptrend. Let me go get this nice pointer thing here. Hopefully you can see that a little bit better. It shows on the recording. So you have these phase one accumulation type bases. So you really want to nerd out on this. You want to be super duper specific, like really go into it. What are the repeatable characteristics you tend to see in these phase one accumulation type bases over the last 100 years, 50 years, 30 years, 10 years? What do you tend to see? Do you notice anything around earnings? If you do notice things around earnings, what are the types of candlesticks that you see? What do you deduce from that? What do you see as a stock transitions and just before it transitions from phase one to phase two? What are the things you are looking out for? This is all about building mental representations for yourself for where specific things happen in the context of this price cycle. So I know we're starting at the basics, we're starting at the fundamentals and the foundations, but getting that right is really important, and everything builds from this. Everything builds from an understanding of the price cycle. Where is the stock? Where is the index within its own price cycle? Same with like group ETFs and theme ETFs as well. So then in phase two uptrends, okay, what are the things that you notice? What tends to happen in constructive and good phase two uptrends? What do you tend to see happens, both in terms of price action, in terms of moving averages? Are there any moving averages? Does stock find supportive action on? If it does find supportive action, what do you notice in terms of the candlesticks? I'm going to teach you about gap down reverse bars and shakeout demand tails. Then as you transition from a top of a phase two uptrend into a phase three distributional top, so around this point in time here, what do you tend to see? What do you see? Do you see kind of a gap up that gets sold into a widespread candlestick and the volume is popped maybe 1.52 times the 30-bar average? Do you tend to see that? Do you tend to see price slicing through certain moving averages? Maybe the 10-day, maybe the 21-day, maybe the 50-day. Like, what do you notice happens at that time? What are you looking for? Again, this is about building the mental representations. In phase three distributional tops, what do you tend to notice happens that is different to a phase two uptrend? So again, in a phase two uptrend and a phase one accumulation base, you're visually trying to identify, okay, what do visual signs of accumulation look like? Absorption of supply look like? And then in phase three distributional tops and phase four downtrends, it's the opposite side of that coin. It's, well, what does institutional distribution look like? So a lot of it is trying to build mental representations for what it is you associate with institutions accumulating and supporting a stock. And then the opposite side, what is it that it looks like to you when institutions are distributing their positions? And then overlaying that, or kind of putting that in the context of this price cycle, phase one, phase two, phase three, phase four. And then at the end of this, I'll then show you where I'm really trying to like dial you guys into this is where you want to be focused. I'm just going to now whiz through a couple of these. All right. So I'm going to show you some for the indexes. So this is absolutely timeless. Okay. The kind of price cycle, the indexes, the stocks, they just move in cycles. It is just how they move. So we've got to have this kind of foundation of, okay, the price cycle, where do we think it is? And this is what we're going to do in the second half, where we start doing some deliberate practice and we start looking at, okay, what are some of the things that we would associate with phase one, phase two transitions, phase three distributional top starting, phase four downtrend starting? What is it that we would associate? And we then link back that kind of visual evidence that we're seeing to the concept of supply and demand, specifically what institutions are doing, what we think their footprint is. So if you take a look at the Dow Jones here, let me see if I can get this annotation to right. What do you notice? Well, it goes in a downtrend, then it goes sideways, then it trends up, then it moves over here, then it kind of tops out, then it does this, and then it moves down. Do you see the cyclical nature of it? Let's go forward another slide. And you're just going to see lots and lots and lots of these. I don't want to teach grandma how to suck eggs too much with this, but you'll just continue to see it. This is the Dow Jones on a weekly chart from 1915 to 1925. What do you see? Like, what do you actually see? So do this with NVIDIA, do it with Tesla, do it with AMD. Spend an hour in your own time just pulling up charts throughout the decades, monthly charts, yearly charts if you want to, daily charts, weekly chart, whatever you want to do. 5-minute charts, 1-hour charts. You'll just see this continues to happen. So there's going to be very specific moments in time where I'm looking to get involved in a stock or potentially an ETF or something like that as well. But it's going to be super duper specific for where we're trying to target, where we're trying to get in, then how we're going to manage the positions. Because everything, if I just kind of jump forward a little bit, everything that we're trying to do is basically from this moment in time here to this moment in time here. So my whole kind of process in terms of identify, control, mitigate, and optimize is specifically focused on a specific area of the price cycle. Okay, it could be phase one transitions into phase two. Okay, but then we're trying to ride the phase two uptrends and exit ahead of phase three distributional tops, which I'm going to talk about on the final slide. But it's all about this. How do you try and nail that? How do you try and nail that? How do you try and nail that? Okay, so your process is very specific for certain areas of the price cycle. Okay, if you think you can be super duper good in every single phase of the price cycle, I wish you the best of luck. I think you'll really, really struggle with it, is my honest answer. But what you tend to see as well is relative strength will rotate between groups. So sometimes you see that growth is super duper good, oil and gas stocks, commodity stocks are getting obliterated. Other times you'll then see, wow, commodity stocks look really strong. They've now transitioned into, say, a phase two uptrend, whereas growth is like phase three distributional top. Sounds a little bit familiar of present day right now, right? So you will see that these rotations happen. So it's not just, okay, the triple Qs look like it's in a phase three distributional top. I'm not going to do anything. No, the money doesn't disappear. The money flows somewhere else. Okay, where's it flowing? Is it flowing into precious metals? Is it flowing into uranium stocks, oil and gas related stocks? Is there another area? Maybe it's solar stock, maybe it's EV stocks. So being able to assess both the market and then go down into the groups, go down into the themes, go down into the individual stocks and go, okay, where do I think this is? Where do I think the money's flowing? If I'm seeing a phase three distributional top over here, is that money flowing somewhere else? Are there then going to be setups that I can be looking to target that are now transitioning into a part of the price cycle where I want to be involved, i.e. phase one into phase two, trying to get out ahead of phase three distributional tops and then being nowhere near the bloody thing when it's in a phase four downtrend pretty much, okay? Let me go back here. So let me just keep going through these. Oh, I've got to go get the annotation. I've never used the Zoom annotation tool before, so bear with me while I try and get it going. There we go. So I'm just going to flick through these a little bit quicker. Maybe I'll talk about some kind of highlight ones, but I really, really emphasize the point. Okay, it's good that we're going to do the deliberate practice bar by bar stuff in 15, 20 minutes time or so, but do just spend an hour yourself. Just spend an hour pulling up charts of the major indexes, the SPYs, the Qs, the Dow Jones, the leading stocks over the decades, and just look at how they move. And then if we just fast forward a couple, ask yourself these questions. Okay, when you go onto the stocks, look at the weekly charts, look at the daily charts, ask yourself this: what do you see? Like, what do you see? I'm going to tell you what I see, and hopefully by the end of this 30-part course, it'll be very, very clear what I see. But what you'll probably find is you'll make your own discoveries, which is really, really important. So there's a fantastic quote by Bruce Lee: absorb what is useful, reject what is useless, add what is essentially your own. So if I tell you something that you think is useful, absorb that information, use it. If you think it is useless, just reject it. I do not take any offense to that. And then add what is essentially your own. By you studying this and going, actually, I'm going to make my own discoveries. You may not know what those discoveries are right now. You probably won't, such as the nature of a discovery. But you may notice things that I haven't noticed. I would absolutely love that. If you do, I'll teach you kind of everything that I think I notice. But questions, some of the key questions, there's more questions than this to ask yourself, but here are the four main ones. What do you see? When you look at this chart, what do you see? And then that flows into the next question. When do you want to own the stock? So if you're long KEX, and this is going from 1977 to 1983, when do you want to own the stock? Like, when do you want to be long the stock? If you're going to be long the stock, you could also ask yourself the other side of the coin. If you want to be short the stock, when do you want to be short the stock? Probably going to be over here, right? Phase four downtrends. But if you want to be long the stock, when do you want to be long the stock? Well, if you start thinking about that in terms of optimization, in terms of optimizing profits, both in terms of monetary gain, but efficiency of the monetary gain, well, let's just draw this forward. Okay, let's just put this kind of base breakout on. Okay, you probably want to be involved somewhere here, which is going to be phase one. It's working quite well, isn't it? Phase one into phase two. So your process is probably going to be focused somewhere in here. So, okay, if you're dialing it in and you're focusing there, then this is where you want to be really specific, really deliberate. If you are focusing there in the context of the price cycle, how are you identifying a repeatable setup? What are you doing? Can you look back over the last 100 years and see that setup works? How do you then control the risk? Because your edge does not come from the setup. Your edge doesn't come from the setup. Your edge comes from the risk management. So that's really important, the controlling of risk. Then the risk mitigation side of things. How do you mitigate risk? Do you want to mitigate risk? That's up to you to decide. Then the fourth part is, okay, if you're going to be involved here, and this is like the real crux of it, the fourth part is, if you're going to be involved here, like think about this, okay, you're kind of pinpointing, yeah, well, if I'm going to be long a stock, I may as well be long a stock here, right? There's no other time on the chart that's better to be long the stock than here. Can I erase that one line? There we go. That's working well, isn't it? There's no better time to be long the stock basically than when it's in a phase two uptrend like this. Again, it's kind of powering out those continuation type bases. If you're thinking about the optimization of profits, both in terms of monetary gain, but also importantly, the efficiency of the monetary gain, the time value as well. So if you're going to be involved in the stock here, does it not make sense to think about, if I'm going to be involved in the stock, how do I optimize the profits? What am I doing? Like, what are my selling rules? What are my selling guidelines? Whether I'm trading on the weekly chart or the daily chart, the 1 hour chart, the 5 minute chart, what am I going to do to optimize the profits? What are the selling rules? What are the selling guidelines that I can use? And then the 80-20 principle is going to be very important when you're thinking about that fourth part of the trade, optimizing profits. Okay, 80% of your profits are likely to come from 20% of your trades. So those big trades where, let's just say you're trading this one on the weekly chart back in 1980, right? These ones here, where it actually kind of powers out like this, it powers out like that. That's the 80-20. Okay, there's going to be times in here, yeah, you're trying to get position there, you get chopped up a little bit. Here, okay, this one kind of goes, rolls over. Okay, it's these trades here. You really want to nail these trades and you want to come to terms. You just want to be at peace with the fact that, well, do you know what? Actually, 80% of my trades are probably going to be nothing burgers. Like, it's not really going to move the needle. The things that are really going to move the needle, if you're more so a swing trader or kind of a longer term position type trader, are going to be those 20% of trades. It's going to be that 20% that make 80% of the profit. So getting those ones right and not messing them up is going to be really important. We'll talk about that a little bit more in terms of the psychology things as well. So let me just keep flowing through here. I'll be quicker on some of the other ones. I kind of want to get to the last side. So just pull them up, right? AMD weekly chart. What are you seeing? When do you want to own the stock? This is actually how stocks move about, how they wiggle and jiggle. You'll tend to see there is a cyclical nature to it. Okay, phase one, phase two, phase three, phase four, phase one, phase two, phase three, phase four. So if you look at Coca-Cola here, and I ask you the question, assuming you want to be long the stock, okay, we'll spend a little bit of time on this one. It's a good example. What do you see? When do you want to own the stock? So hopefully your eyes are drawn. Again, if you're thinking about owning the stock in terms of, I'd like to make some money in the stock and I'd like to make a pile of money in quite a short period of time, where is the best time to own the stock? If you ask yourself the question, you phrase the question like that, when do you want to own Coca-Cola on this chart? Tell me. Like, hopefully your eyes went, well, I would have liked to buy it somewhere around there. And then the question is, well, how would you have optimized the profits? This is the 10-week SMA, this black line you see here, 50-day moving average. So if you're going, well, I classify myself as a longer term position holder or a trend follower, and I like using the weekly chart, I like using the 10-week SMA, well, that would have been pretty good, right? So imagine if you had bought the stock here and sold the stock here. Would that be a good trade? That is probably what I can see and what I would look at it. If you are thinking about, well, can you identify that on a repeatable basis? Check. Can you control the risk? Check. Can you mitigate the risk? Check. Can you optimize the profits with some pretty simple selling guidelines? Okay, buy it there, sell it on the first close below the 10-week. It's not that complicated, is it? And then you've just captured all of that. So if you're thinking about the monetary gain, check, it's large. If you're thinking about the efficiency of the monetary gain, check, it's large as well. And then it got you out and you didn't then hold the stock for the next however many years is that? That's kind of nearly 8 years or so where the stock didn't go anywhere. It went down. But then the question becomes, okay, this is then obviously into a phase 3 distributional top, into a phase 4 downtrend. So this is where we go a lot. The first kind of 4 videos, 4 kind of sections of this course is going to be heavily linked to pattern recognition. Like, 99% of trading is pattern recognition. The other 1% is kind of everything in between your ears, right? But 99% of it is pattern recognition. What do you associate with accumulation, absorption, and supply? What do you associate with distribution? So if I was to ask you a simple question and say, do you notice how the stock is moving? If we were to call this area, this is like the uptrend, right? I'm just going to put up over here. And if we put DT, the downtrend over here, what do you notice is the difference? Now we're starting to go a little bit into the weeds here in terms of supply and demand, what we think institutions are doing with this stock. So what do you notice is the difference in terms of the candlesticks, which come on to candlesticks when we start going through trigger bars, shakeout demand pairs, gap down reverse bars. What do you notice is the difference here in terms of the uptrend, in terms of the candlesticks? Then what do you notice is the difference when the stock is in the downtrend? What do you start to see in terms of the candlesticks and also the volume, giving you a little bit of a clue there, also the volume, what do you notice is happening in the context of a downtrend? You see these widespread red candlesticks. So I call these bearish synchronicity. There is a synchronicity between what price action is doing and the volume is doing, and it's bearish, right? If you're trying to be long the stock, it's bearish for you. Okay, if you were vice versa and you were short the stock, you'd say it's bullish synchronicity because it's going down, right? But bearish synchronicity is what I call this. These are widespread candlesticks. This one here that acted as the change of character. Widespread candlestick, pop in the volume. This is what institutional distribution looks like. You see these lots and lots of these red weekly bars, and this is the same on the daily chart or the 1 minute chart or the 5 minute chart. Okay, obviously the higher time frame you are and the more kind of important the stock is. Coca-Cola, pretty institutional stock, right? So we could think about that as Nvidia or Microsoft's or Amazon's or Uber's or Meta's of the day, right? But if you start seeing this occurring in a stock, certainly like on the weekly chart, and it's kind of a key market stock, let's say Nvidia, if you start seeing 3 weeks of action like that on Nvidia, what do you think institutions are doing? What do you think they're doing? Certainly if the relative strength line is now hitting 52-week lows. So what do you notice about the relative strength line in this kind of downtrend area relative to the relative strength line in the uptrend area? Well, one had blue dots, put simply, one had red dots. One is showing outperformance to the index, in this instance here, the S&P 500. The other is showing relative weakness. So this is where the pattern recognition starts to dial in. You start to go, okay, there's things that keep happening. There's things that keep happening when I want to be involved in the stock. There's things that then happen where I don't want to be involved in the stock, which is like the ending of the trend. So kind of having the courage of your convictions to ride the trend as far as it wants to go, subject to your selling rules, selling guidelines. Now, you never know. You wouldn't have known in 1995. You wouldn't know in 2024. You wouldn't know in 1905. When you get on board a stock, you do not know. You have no idea whether it is going to go up 5%, 50%, 500%, or if you're going to get stopped out 5 minutes later. You just have no idea. Nobody does. So that's the thing about just letting the variance of results play out over a large sample size. So sometimes, like now, for instance, you can be getting chopped up in positions. Okay, you have 3 losing trades, 4 losing trades, 5 losing trades in a row. You have to try and then think about things over a larger series of trades. We'll come on to like psychology and things a little bit later on. But Apple, I don't want to spend too much time on these ones, but Apple, Amazon, hopefully your eye is just being drawn to, okay, goes sideways, goes up, tops, goes down. Go do another one. Crocs, goes sideways, goes up, comes down. So remember what I said about the change of characters, right? This is just a good one to highlight because this is a clear-cut example as you will ever see, okay? So the question to ask yourself is, what is institutional, a really key question to learn and then have the mental representations, which is just basically visual things that you associate with an idea, with a concept. So a visual or kind of a mental representation that I would associate with institutional distribution is this. It's the wider spread. This is on, I think, arithmetic scaling. I'm going to put this one on because log scaling didn't really show the severity of this decline, like nearly 99%, right, for what was a leading stock. But if you're asking yourself the question, what are institutions rushing for the exits? Not just like mildly exiting positions, like rushing for the exits. When they start rushing for the exits in a hurry, what does it look like? That is what it looked like. This is what I call bearish synchronicity. It's the highest volume bar on the weekly chart ever for Crocs. And what did the price do? And what do you deduce from that? Well, it opens near the high of the week. It goes out near the low of the week. This actually occurs, this weekly bar, on earnings as well. So to give that even greater weight. as we're going to see in the second half of this session, we're going to talk about when we go bar by bar about the earnings reactions that we see. We get a good sense of, okay, what are the bigger boys and girls up to or not up to around the earnings. But this here, okay, widespread candlestick looks horrendous. If you wonder what institutions rushing for the exit looks like, it looks like that. Now, remember what we were talking about with Coca-Cola. These are couple decades apart, decade apart or so, right? But it's the same concept. Supply and demand is timeless. If you think really, really logically about it, okay, institutions and you and me, we can only really do one of two things. We can buy and we can sell. We can accumulate, we can distribute. It's really that simple. So what you're trying to do in terms of your analysis is try and dial it in and go, okay, leading stocks, what am I seeing institutions doing? Do I think they're buying, so accumulating positions, or do I think they're distributing the positions? And we want to be on the side that the institutions want to be on. For me, I just focus on the long side. So for me, I want to be in the stocks where the institutions are in there and they are proactively accumulating, and I can see their footprints. Does that mean I'm going to be right every single time? Absolutely not. But I want to be in the stocks that I deem, okay, the institutions are there, I'm seeing money flow there, the group is preferably strong, the brother sister stocks are strong, so on and so forth, right? So there is a big difference between how this stock goes from point A to point B up here, from then point B to point C. This is what accumulation looks like. This is what distribution looks like in kind of very, very simple terms. Let me keep going forward. Let me see if I can find a couple of other ones. Zoom, no, these will be ones you're familiar with, and then I want to speed it up a little bit. Okay, so you've got Zoom. Again, Zoom, just absolutely classic price cycle, right? We're using Zoom right now, okay? So it's interesting when you then see a stock that you use the product as well, right? So if you think about Zoom, right, what do you see? Phase 1 base, phase 2 uptrend, phase 3 top, phase 4 downtrend. And what do you notice happens? So we're talking about the repeatable characteristics that you tend to notice in each phases. Don't worry, we'll go really deep into this when we go through like trigger bars, shakeout demand tails, and gap down reverse bars. It's just a bit of a high level overview, just so stocks tend to move in similar manners in terms of phase 1, phase 2, phase 3, phase 4. So what do you notice as the stock transitions from phase 1 to phase 2? What do you notice? What do you notice in terms of the price action? What do you notice in terms of the volume? The volume's increasing. Volume, activity, volume, effort. There's a lot of eyeballs. What do you notice about the relative strength? It starts hitting 52-week highs. Interesting. Then where does the trend end for Zoom? Well, when it starts closing below, it's 10 weeks. So if you're trading off the weekly chart, that may be a useful selling rule to have for you. And then what does it look like when the stock is in a phase 4 downtrend? We've seen a lot of these bars coming through. So you see these bars here in the phase 4 downtrend. You want to see the opposite of that in phase 2 uptrends to indicate it's still pretty healthy. Widespread candlesticks, open on the low, close strong, indicating there's a lot of buying, a lot of demand, certainly if it's being confirmed by volume and also relative strength. Really, really constructive signs to see. Let me try and delete all of those, still learning my way around these annotation tools. Peloton as well, phase 1, phase 2, phase 3, phase 4, it's the same thing. Fastly, phase 1, phase 2, phase 3, phase 4, it's the same thing. DocuSign, what do you notice? Phase 1, phase 2, phase 3, phase 4, phase 1, maybe, right? Neo as well, phase 1, phase 2, phase 3, phase 4. It's the same thing. Again, worthwhile, just spend an hour looking at some of the stocks that I've shown you here and 10, 20 other ones as well. You look at NVIDIA as well. When do you want to be long NVIDIA? You probably want to be long NVIDIA, right, where it starts trending and showing a lot of relative strength. So this is where we're then going to start going much more into the weeds. We'll look at that. Potentially a couple of setups from NVIDIA as well. So then the point is, okay, which is the kind of logical flow to this. As I said, trying to design this, when I teach Ella to trade, this is kind of how I would teach Ella to trade. So if you're deciding to yourself, you're like, okay, this is actually an inverted head and shoulders type pattern. So you have the left shoulder over here, you have the head over here. Don't worry, you'll learn all about chart patterns as we go forward. And then you have the right shoulder over here. Okay, NVIDIA then starts transitioning from this phase 4 downtrend, this being phase 4 over here, into phase 1 and then into phase 2. So then if you're asking yourself the question, okay, well, I've already decided I'd quite like to be involved like in transitions from phase 1 to phase 2 or phase 2 continuation type bases. And then it's about kind of nerding out a little bit and really going down the Alice in Wonderland hole and go, okay, if I'm specifically focused here, like this is the time. Okay, here it like chops around, it then sets. This is a really, really good weekly base, like really, really, really good. But imagine you're focusing your attention here and you're like, okay, this is where I want to be involved in leading stocks. I'm going to teach you about the three types of stocks in a couple of weeks time. Okay, like TMLs, momentum leaders, group theme leaders. Then you want to go, okay, if I'm going to be really involved here, this is where, and everything that then kind of focuses on this center point in terms of your screening, your systems, your day-to-day routines as well. Because as we start going down the Alice in Wonderland rabbit hole, you'll start to notice there are common characteristics that occur here within this zone. So we're looking high level right now. We're going, okay, phase 1, phase 2, phase 3, phase 4. But then as we start really pinpointing things in terms of the identification process, okay, we're looking there, but specifically, what are we looking for? Like my mind, I hate vagueness. I hate subjectivity. It's got to be really, really clear. Like logically, I have to be able to understand something. I have to be able to see it. Okay, I've got to be able to see it. So this is where we're then going to go trigger bars, shake out demand tails, gap down, reverse bars. You will see those on the weekly chart as well. There's a shake out demand tail over here for NVIDIA. But let's keep going forward. A couple of more. Let me kind of go. I think I'll probably go to the M1 now as well. Monster Beverage, and kind of the same. These are just to show it's not just US stocks as well. Okay, UK stock, Boohoo Group. Many of you have traded the UK market over the last 10 years. We know. So phase 1, phase 2, phase 3, phase 4. Right. So again, it's just I'll just highlight this one because I think it's a good one. So where do you, if you want to be long the stock, where do you want to be long the stock? Right. If you don't want to be long the stock, where do you not really, really want to be long the stock? Probably over here, right? Phase 4 downtrend, phase 2 uptrend. So what are the characteristics that you tend to notice repeat across a lot of stocks over the last 100 years when you look back here, when they're in powerful uptrends, building a continuation type basis? Again, thinking about things from both, can you consistently identify the setup? Like, can you see it? Can you control the risk, create the asymmetric risk versus trade? I'll repeat, your edge does not come from the setup. It doesn't come from, oh, great, I identified a flag right here and it's in a powerful weekly uptrend. Okay, great. But what if you think you identified the flag over here in phase 2 uptrend and this thing is just going to go to the moon? You didn't put a stop loss, and then you ride this thing. This will be in pence. So you ride this thing down from £3.25 to 31 cents. This is why I say your edge does not come from the setup. It comes from the controlling the risk and the risk management and the trade management. That's where your edge comes from. So the game is really played once you're in the position, when you have your stop loss, when you're thinking about mitigating risk. And then also, what if you bought this on the weekly chart and then you sold it 2 weeks later right here? That's in the optimizing profits. So the game is really in the trade management. So the setups, relatively easy to identify as soon as you kind of learn them. I don't think it's rocket science, but where the game is really played is when the trade is live, when it's open, and you have these conversations with yourself in your head. Like the amount of things I think that you will learn about yourself, the kind of self-discovery of trading, and the amount of times you will basically shoot yourself in the foot. As much as you can listen to me and listen to someone else, you can read a book about these rules are quite important. Maybe you want to follow them. Sometimes actually having the pain of messing it up is the thing that gets you to change. So I have held stocks down like over 10 years ago. I would start off LSE, which lse.co.uk is like a UK bulletin board. It's AIM, it's the wild, wild west, right? And I basically just look for what are the stocks most being talked about, because I think my analysis was, well, if a lot of people are talking about them, it must be good, right? And then they're just story stocks, okay? It is invariably on kind of AIM, the wild, wild west. It is oil and gas stocks drilling off the coast of somewhere. They are just have debt just up to their eyeballs and above, basically, and it is just death or glory with them. So I had bought numerous stocks where I basically bought it up here thinking, fantastic, sorry, just watched a YouTube video of the CEO on YouTube, looks great, shiny shoes, all of that, really, really new as onions, and I would just buy it there, wouldn't use stop loss, and literally 99%. Just everything, like a lot of the companies just went bust. Okay, that was it. That was their one shot at glory, and just lost it. So I've been there, I've done it, I've made every mistake in the book that you could possibly make, and I've made it a couple of times as well. So when I hop on about things, it's usually because, believe you me, I've had the pain of it. I've had the pain of the mistake. So again, a lot of trading, as you start then putting rules in place for yourself, and you start going, okay, here's how I'm looking to identify, here's how I'm looking to control, here's how I'm looking to mitigate, here's how I'm looking to optimize, is you'll experience a lot of pain within those 4 areas when you are not following rules or you don't have rules. So one of the things that can be really, really painful, maybe one of the most kind of painful things, is my dad does this and it pisses me off a treat. Like, don't get me started. But like, he'll have stocks where he's bought it, textbook, like bought it there. Happened with a stock called a Vactor a couple of months ago, right? Had a really good gain on the trade, basically then had a really obvious bearish change of character. And I was like, that you need to exit. Like, I don't want to tell you what to do, but get out. At least lighten up. No, no, no. The story's good. It's the weak hand's been shaken out. Okay. Okay. Okay, basically. But again, some people they have to really, really experience the pain before they'll change, and some people are extremely stubborn and then won't make the changes. So hopefully that's not you. But sometimes it does take that. We've got a really good gain on the stock, and then suddenly you start to give back a load of profits, and you're like, I had a gain of 50%, hundreds of percent on this stock. Now I've just given everything back, and now I've got a loss of 50%. Sometimes that will then make you go, okay, if I'm going to do this, I've got to start optimizing profits. I've got to start thinking about this. What are the selling rules? What are the selling guidelines that I'm going to follow? And then just follow them. Something that I also think is useful, certainly from a psychological standpoint, we'll talk about this a little bit later on in the course, is have different accounts. I'm not telling you what to do, but for me, I'm just telling you what's useful. Have different accounts. Like, have different accounts. I have ADHD, I have a lot of other things. So for me, I can be my own worst enemy. So I actually have to have accounts where I am protecting my family, so Louise and Ella, from myself, because I can do some pretty stupid things. So having accounts where you're like, so for me, I have kind of active swing trading accounts, I have longer term accounts, and then I have something that I just call the yellow account. I'm just never going to touch that. Basically, I just put money into it, buy the Qs, buy the S&P 500, maybe buy a couple of what I think are like leading stocks like the Nvidias of the world and stuff. Just leave it low. Okay, I maybe look at it once a month because that's just the yellow account. I hardly want to do anything in there. Whereas my active trading accounts, every day I'm in there. I'm trying to do things. So having different accounts that suit your personality, suit your financial objectives as well, I think is prudent. That's just me and how I kind of think about things. But anyway, let's kind of sum this up in terms of the price cycle overview. So hopefully where we've got to, and we'll start doing a little bit of bar by bar deliberate practice. Hopefully where we've got to by now, I've been rambling for a little while, is you've started to realize, and I appreciate many of you will already realize, but there's four main phases. They can kind of ebb and flow and look a little bit different, but there's four main phases we want to have in our heads. Okay, where do we think, if we speak specifically about stocks now, where do we think the stock is? Do we think it's in a phase one accumulation base? You'll see that in the trend monitor on the platform as well, you'll see that I'll sometimes categorize it with an E or an L. So I'll say like phase one E or phase one L. So if I say like phase one L, what I'm saying there is late. So for me, phase one L, it may be, if I just highlight over here, it may be over here somewhere. Okay, it looks a little bit later in a phase one base, and then maybe it transitions into a phase two E, so early in a phase two uptrend. So what we have is we have four phases. Each of those will have unique and common characteristics that we start to associate things. This is the mental representations of, okay, what do we see in terms of the price action? What do you tend to see? And again, this is then you. You may see things differently to me, and that's absolutely fine. Again, it's the Bruce Lee quote: absorb what is useful, reject what is useless, add what is essentially your own. Okay, if you don't find something useful, that's fine. There's no point having an argument about it. Just use what you think is useful. Okay, if you start thinking, oh, I could use the MACD and stochastics and the RSI and things like that, and you find it useful and you make more money doing that, use it. You may look and say you use like the MACD or the RSI and things like that and go, actually, I really like using that because it really helps me. When I start to think, technically, I'm seeing a stock transition from phase one to phase two. And it also really helps me, say, like RSI divergences, when a phase two uptrend is turning into a phase three distributional top. Maybe on the RSI, you start to see lower highs forming. And maybe you find that really useful. So that is the part where you are adding what is essentially, I bet those of you are now looking at RSIs and MACDs and stuff like that. But that's the point where you're just adding what is essentially your own. But I think this framework here is time tested, like we looked at with the chart of the Dow Jones. This just continues to happen. It's never going to go away. And the reason it will never go away, it doesn't matter if kind of AI is trading. It's algorithms, which most of it's already algorithms anyway, but it really just stems from large operators in the market will accumulate positions and then they will distribute positions. And it's really that simple. So if large operators in the market, and I'm talking the really big boys in the market, if they continue to accumulate positions and distribute positions, and remember, because of the size that they are trading, it takes time. Okay, they can't, if Fidelity want to go and buy a mega position in a stock, they can't do it in a single day without pushing the price up a couple 100%. So it takes time for them to do that. So if it takes time for them to accumulate a position, guess what? It probably takes time for them to distribute a position because they don't want to particularly shoot themselves in the foot and drop the price down 50%, 75% in a day because they just sell everything that they possibly can. So this is why large operators in the market taking time to accumulate and distribute positions will continue, in my view, to play out like this forever and a day. I don't think it will ever change. And if you then believe that concept, or you see that concept for yourself and you go, well, that kind of sounds quite logical. Okay, if I'm a Fidelity and I've got 10 billion in terms of assets under management, I can't go and buy $10 billion worth of Nvidia stock in a single day without pushing the price, and I don't really want to do that. So this is why you tend to see repeatable characteristics in terms of phase one accumulation, phase two uptrends, which again is accumulation, absorption of supply, i.e. gap down reversal bars, trigger bars, shakeout demand tails, price respecting certain moving averages, and then in phase three distributional tops where your Fidelity of the world go, okay, right, we've had this stock from phase one to phase two, now transitioning into, they won't necessarily call it like phase three, but the characteristics is phase three distributional top is, okay, your Fidelities of the world have ridden this stock up, maybe they're up a couple 100% in it, start to go, okay, we're going to ease off here. We're now actually going to start moving money from semiconductors and growth into commodity oil and gas stocks, because that's where they see greater potential over the next 3 months, 6 months, couple of years, whatever it may be. So that's where you start to see, okay, there's repeatable characteristics when the Fidelities of the world start exiting their position, start distributing their position. So they're no longer supporting the stock, they're distributing the stock. But again, it's the time element. It takes time for them to do that. Okay, it's like an oil tanker. It takes time for it to turn around. And then it's the repeatable characteristics of phase four downtrends. So just to summarize as well, a useful quote from Warren Buffett, be fearful when others are greedy, greedy when others are fearful. That basically sums up large operators. So just to repeat that quote and overlay it with the price cycle. So Warren Buffett, who's a large operator, be fearful when others are greedy, i.e. phase three distributional top. The stock's gone a long way. Be fearful when others are greedy, and then be fearful when others are greedy, and greedy when others are fearful. When do you think others are fearful? Well, it's going to be down here. Phase four downtrends. Large operators, two things are required above everything else, liquidity and perceived value. So then just to finally finalize this one. So kind of the process that I'm going to be teaching you in summary, the Blueprint Trading course in summary is how to get positioned in leading stocks as they are basing, mitigate risk, ride trends, scale out as the trend ends. So you see here, if we just speak about this phase two continuation type base here, okay, phase two uptrend, 1 and 2, get positioned and mitigate risk. These here are all kind of targetable entry points as you go along, trigger bars, shakeout demand tails, gap down reverse bars. Ride the trend, scale out as the trend ends. In a nutshell. In a nutshell. So let me go and load up a couple of things and we can start doing a little bit of a bar by bar. So hopefully that was kind of a useful overview. In the next one, we're going to go into trigger bars. That'll be next Tuesday. And as I said, we'll do one a week. So if we have any willing volunteers, let me know and I'll bring you guys in. I can see that Sam has asked a question. I'll answer that one at the end for you, Sam, so I can keep it kind of rocking and rolling on this one. So I'll wait for any willing volunteers. Let me just talk about kind of gold. So then this is just like the nuance of things. No willing volunteers, fine. I can rock and roll by myself. But if you take a look at GLD here, okay. So this is in essence what it is we just been speaking about. We're going to do the weekly chart here for a couple of these next ones. We're going to do we're going to do daily charts, which is also where I focus my attention. Okay, but if you look at gold here, okay, it's in a phase one accumulation type base. So here's a couple of nuances that you're going to start picking up on, and it's really useful when you start kind of learning about these concepts, and then you link everything back to supply and demand. What you'll tend to see in phase one bases as well is a changing of character, and sometimes it works quite perfectly that it's like the middle of the base. Sometimes it's like 75% of the base is that, and then the final 25% is that. But again, it's just the common characteristics you tend to notice as a stock is basing. You will see it kind of, it'll change character. Sounds a little bit out there, right? But let me start describing it to you a little bit, okay? So when you're looking at a phase one base, okay, now this over here would be, we're just going to call this now phase two, okay? So now phase two uptrend. Let's do this. So phase two uptrend is over here, and then this here is going to be your phase one accumulation base. It was kind of like a big reaccumulation base. Reaccumulation. How to using it? Maybe it does. That's my dyslexia. So anyway, this one here, right? So you're looking at GLD. Let's split this in two like this. Okay. So a couple of things to be on the lookout for. Number one is ideally you'd like to see, so we'll do kind of the orange zone and then the pink zone, right? So as a base is transitioning, what you're looking for before a stock comes out of a continuation type base, which we'll look at next week with trigger bar, so flags, wedges, pennants, Darvis boxes, cup and handles, VCPs, ascending triangles, channel, all of that stuff, right? We'll look at all of that. What you'll tend to notice is before the stock comes out of that continuation type base, you'll tend to notice common characteristics, and then you can back it out a little bit further and go, there tends to be other characteristics that you notice as well. So what I'm going to do is just zoom in like this. So we know that gold has come out of this base. It's looking pretty strong. Ideally, pulls back, precious metal miners set up. That'd be quite nice. But if you look here, okay, in this orange zone, what I'm going to actually do is just point to the rallies. Okay, point here, and I'm going to point here. So what you're looking for is you're looking for a change of character in a positive sense. And when I say change character in a positive sense, what you're looking for is you're looking for evidence that demand is now stronger than supply, so price goes up. And you're looking for how easily or not price goes up. This is going to be the point in terms of bullish synchronicity. So when you take a look here, okay, gold is in the left-hand side of the base. So if we just call this, is it going to be confusing if I call it 1? Let's call this A and B, right? So we've got the A hand side of the base being over here, and then we've got the B hand side of the base being over here, okay? So we've split the base into two halves. We've got the A side and we've got the B side. That's not to say the A team is better than the B team or the B team is worse than the A team. It's just A and B for annotation purposes, right? But what we can see in the A side of the base, this amber zone, is gold is in a downtrend. It's making lower low, lower high, lower low, lower high, lower low. Okay, interesting. If you then look at the quality of the rallies, so we're going to look at this one here, and we're going to look at this one here. And let's just circle the volume. So we can circle the volume there, we can circle the volume there. So if we now just call this rally attempt number 1, and then let me try and point to it. So now we are just going to go 1, and then we're going to go 2 like this, okay? So rally attempt number 1 and rally attempt number 2. What do you make of it? What do you think? Is it any good? And link it back to the concept of supply and demand. When you look at rally attempt number 1, what do you notice about the volume first and foremost? The black line down here is the 30-bar average. That's consistent across all of my charts. 1 minute chart will be the 30-bar average, daily chart will be the 30-bar average, weekly chart, 30-bar average. It's just consistent. So what do you notice about the volume on rally attempt number 1? It's feeble. So think about volume as activity and effort. There's not a lot of activity, there's not a lot of effort. And then when you start looking at the price action itself, does this look like, again, the visual, the mental representations, does it look like there's a lot of buying? No. Are the candlesticks wide? No. You can see wider candlesticks over here, you can see wider candlesticks here, you can see wider candlesticks here. So it's just a feeble rally attempt to a lower high. There's not much demand, okay? Rally attempt number 2, much the same, right? It's a feeble rally attempt, just indicating there's not a lot of buying here for gold. And the volume is low. Now we start to go into the B side of the base, okay, in this pinky purple zone, right? What do you notice here? If we were to label this, we were to label this, we were to label this over here. So what we could now do is we can go call these 3. So this is about understanding the change of character that stocks will often go through as they are basing. Now, sometimes you can see this on the weekly chart like this, you'll see it on the daily chart, the 1-hour chart, the 1 minute chart, okay? But if you look at rally attempt number 3, let's just look at the volume first. What do you notice about the volume attempt on rally number 3? Interesting. The volume now for 3 weeks in a row is above the 30-bar average. Interesting. What happens in terms of the price action? Widespread candlestick. Opens on the low of the week, closes strong. Opens on the low of the week, closes strong. There's more of a shakeout demand tail, the 3rd bar in there. But does it then make, what does it then do structurally? It makes a higher high. This is a change of character for whatever reason. Now, maybe you can go and find articles about it. I don't care about the news really. Just focused on what is. So what is happening here for gold is this is a strong rally attempt. Now, there may or may not be setups right now. So then we link it back to an individual stock basis. Is the stock setting up as per your criteria or stocks related to this? So precious metal miners, gold miners, silver miners. Probably not if it's very V-shaped in nature right now. Similar to this, right? But it's a change character. something somewhere has happened for gold and people have acted on it. And people have acted on it in quite a big way, thinking about volume as effort and activity. High relative volume, uptick in the RS line. Okay, something's a little bit different here. Then we look at the pullback. So in between those, in here, what do you notice about the pullback? Does it make a lower low or a higher low? Makes a higher low. Higher lows, structurally bullish. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. That's going to be bullish behavior. Lower lows, lower highs, lower lows, lower highs is going to be bearish behavior. You got it. Certainly, if there's feeble rally attempts like we're seeing at 1 and 2. So number 3, okay, a little bit of a change in there, right? Now let's look at number 4 over here. Again, what do we notice? Well, price rallies first 2 weeks on not much volume, then a bit of volume coming through, and again it makes a higher high. Opens on the low, closes strong, good volume coming through. Now here it's very V-shaped in nature. Yeah, it's still a good sign. But if you're then thinking about, okay, are there potentially stocks setting up as per my criteria? Maybe there are, maybe there aren't. It depends, right? But here's something else you can see as well. Now, something that's not great about this chart is the deterioration in relative strength as this is happening. On an individual stock basis, it would be better if actually during this consolidation in here, okay, you actually have the relative strength turning up. 52-week highs in the base, really, really good sign. We'll cover that in coming weeks. So what do we see here? So what do you see in this zone here? If I now just clear this up a little bit, let's maybe just make this blue like that. Not going to show up. You guys see the blue? There we go, kind of like blue, okay? So something that you'll tend to notice is ideally you'll know evidence of demand and a positive change of character. So bullish synchronicity, like we were talking about with 3 and 4. There's a change of character for gold right now, okay? And then what happens? Remember the red line? The red line is going to be the 40-week. The black line is going to be the 10-week SMA. What do you notice? Well, gold seems to undergo this period of contraction in this bluey zone, right? Underneath the base highs. So here is something else to ingrain. So again, it's the repeatable nature of things. It's the characteristics that you associate with a stock doing, or GLD in this instance, the proxy ETF for gold, before they come out of continuation type bases. What do you see? Well, on a relative basis, a lot of the candlesticks are quite tight. So the real bodies of the candlestick, that's the difference between the open and the close, are quite tight. The volume generally dries up from left to right, and there are signs of absorption of supply with what I call shakeout demand tails. So I'm just going to point to them like this. Let's make this one here and point to it in pink. Okay, this one here, this is a shakeout demand tail. So price goes down, and we'll do this in a lot more detail in 2 weeks' time when we do shakeout demand tails. But if you look at this shakeout demand tail, it undercuts the last 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of trading. And the volume's still below the 30-bar average. See how the volume really dries up here? So undercuts, this acts as a shakeout, this shakeout demand tail. So it's constructive to see tightness in price, shakeout demand tails, and then you get what you're going to learn about also a trigger bar, tight bars, low relative volume, sitting around 1 or more key moving averages before the transition out. So before this happens, okay, invariably you'll start to see this. So if we just link this concept back again to, let's just use Fidelity, right? I'm just using Fidelity as large operators because you've all probably heard about them. Right? If Fidelity are going to go build a mega position in gold because they think they've listened to Jim Rickards or Peter Schiff and they think gold is going to go up to $5,000, $10,000 an ounce over the next X amount of years, right? Let's maybe take that out, but that's a little bit harsh. Let's say Fidelity go, actually, we've assessed everything and we think the price of gold is going to be X% higher in 2 years' time, a year's time. What are they going to do? Well, they're going to have to build a position. And because of their size, can they build a position in a single day? It's going to take time. So this is the time. So what I try and do with when I look at a chart, I'm trying to link it back to what do I think the Fidelities, the JP Morgans, the sovereign wealth funds, the mutual funds, the pension funds, what do I think they're doing? What do I think they're up to? So this is where you start to see their footprint. So a lot of it, as I said, 99% of trading is really just pattern recognition. The other 1%, obviously, it's risk management, it's position size and all of that, but somewhat kind of all in the pattern recognition side of things. It's not 99% pattern recognition, but a significant part of it is pattern recognition. And it's pattern recognition in the sense of, what do you think Fidelity are doing? What do you think JP Morgan are doing? What do you think the pension funds, the mutual funds, the sovereign wealth funds are doing? What are they up to? And it's going to take time for them to build their positions. So this is where you start to see them, the footprints, is them building the positions. in the phase 1 basis, in the phase 2 continuation type basis, in the phase 3 distributional tops, as we'll come on to in a little bit, that is where they're distributing their positions. Now, I will just touch on quickly the Richard Wyckoff law of cause and effect. Big causes tend to lead to bigger effects. So if you see a multi-week or a multi-year base building on a weekly chart, the move to the upside or the downside, if it's a big phase 3 distributional top, is likely to be greater than that if you saw it on a 5-minute chart and maybe it had been basing for an hour. Okay, the size of the move is going to be different. So let's do a couple of other ones. Let's now transition onto the daily chart. I'll answer Adrian's question at the end. Yeah, sure, no problem, Adrian. I'll answer that one at the end. So let's just start here, okay? So I've tried to pick some that I was targeting at the time. So I was targeting YPF here. It gapped and I cancelled my order. I could have then got filled on a pullback and it would have been a good trade, but it is what it is. But let me take you through the thought process. Okay, so this stock here, now it is more so in a phase 2 uptrend, but just kind of just roll with me here a little bit. Imagine that this is a phase 1 accumulation base and it kind of is like a phase 1 reaccumulation type base. Okay, so this is what we're looking at. Okay, now here's an important concept. Institutions create their lows. Liquidity, perceived value. 2 things they require above everything else. So a useful exercise when you are looking at a chart is look around the lows. Okay, so if you're looking at a phase 1 accumulation base, a phase 2 continuation type base, again, what you're trying to do is just train your pattern recognition to go, I've seen this 1,001 times before. This tends to happen. So around the lows of bases, you'll tend to see if institutions are in there supporting it, because it's the institutions that create the lows, you'll tend to see their footprint. And they go, thank you very much, enough liquidity, perceived value, we're stepping up. Now, oftentimes it can happen around certain moving averages as well. So the ones that, if you're going to use the 4 in my view is 10-day EMA, which is the black line, 21-day EMA, the blue line, purple line's the 50-day moving average, the red line is the 200-day moving average, and I have the 100-day moving average, which is the grey one. Do you really need the 100-day? No, but for me, it's just a nice reference point between the 50 and the 200. And sometimes you can see it like stop on a dime around the 100. But the full ones, 10-day, 21-day, 50-day, and the 200-day. So when you're looking around the lows over the next 3 weeks, you're going to learn about trigger bars, but you're also going to learn about shakeout demand tails and gap down reverse bars. So the most common to see around the lows, if it's constructive and you're seeing the footprint, again, the footprint of large operators, they're stepping up. Yeah, enough liquidity, perceived value, we're stepping up here. Is going to be shakeout demand tails and gap down reverse bars. So let me show you briefly what they are. This is a shakeout demand tail, okay? So it's got a little tail on it. Don't really learn all about it, but here is a shakeout demand tail. Here is a gap down reversal bar. The prior closes here, gaps down, opens near the low, pushes up. Interesting. Large operators trying to shake weak hands out of their positions. Over here, what do you see? You see a shakeout demand tail. Over here, you see a shakeout demand tail. So if we were to kind of split this, and as I said earlier, it's not perfectly, like oftentimes like GLD was kind of quite perfect, wouldn't it? You kind of draw a line down the middle of the base, and we discussed the difference that what we saw in the first half of the base to the second half. Well, we could do the same exercise here with YPF. Okay, if we were to do this, pull this across, and if we make this side of the base amber, and don't worry, we're going to talk about the gap up there on volume as well, but you start to see how the character of the stock is different. And again, I know it's really, really nuanced, and it takes a long time to train your eyes to see certain things. And as I said, you may see things differently to me. We're all looking at the same thing right now, okay? Assuming you're looking at this chart, we're all looking at the same thing, but we're all going to interpret things very different subject to our training and how we just filter that through in terms of our own beliefs, what we think about trading, how we associate certain things. But what I'm trying to do is teach you the mental representations that I have about when I start to see things. So if you look here, bearish synchronicity, bearish synchronicity, bearish synchronicity, bearish synchronicity, bearish synchronicity. The stock ain't looking too good, is it? But then you start to get the change of character. And we're going to go deep into the weeds here. So from the first half of the base to the second half of the base, are you visually seeing how the stock starts acting differently? Like this, not good. There's no setup there. This, when it starts to get really constructive, like this, as we're going to learn about more so in the setups, is really good to see. So what you'll start to see in these continuation type bases, in these phase 1s, as they look to transition into phase 2, you'll start to see visually from a supply and demand perspective, when you're interpreting the price action and the volume and what's going on with the relative strength line as well, you start to see the footprints. Now, just because you identify, okay, it's doing this, it's doing that, it's doing that, doesn't mean that the stock is going to be a winning trade. It's not to do that, but it's understanding why you're reaching the conclusion that you are reaching. You really want to understand. If there's one thing that I will try my best to teach Ella, both in terms of trading, but in terms of life as well, is understand why you are doing something when you are doing it. Like, be conscious, be aware of your decisions. Your decisions matter. Every decision matters. Okay. So when you're looking at a chart, well, why are you reaching the conclusion? Why did you do what you did when you did it? That's what I want to know. Why did you do it? Why did you take that trade? Why did you put your stop loss there? Why did you mitigate the risk? Why did you not mitigate the risk? Why did you mitigate the risk at that level instead of that level? When you're then selling a position, well, why did you sell your position there? Why did you sell it there, not there? What was the thought process? What was the thinking? What were the inputs? So with trading, it's really inputs, outputs, and having a process and understanding it. And it's also trying to determine the quality of your decisions. Do not judge it by the outcome. You could make a really, really bad decision and the stock next day gaps up 100%. But you could have just bought a stock that's getting absolutely just smashed off the face of the earth. And then the next day it gaps up 100%. And you think, yippee, yeah, I'm going to do that again. So now suddenly you start looking for stocks that are just getting smashed in terms of phase 4 downtrends, because one time you bought the stock like that, maybe it then went down 20% and then it gapped up 100% the next day on like a takeover rumor or something happened, right? So you think, well, that was good. I'm just going to do that. That's probably not going to work out too well for you if you do it over a large series of trades. So where we want to get to is you're thinking over a large series of trades. Anything can happen on any one specific trade, but you're trying to think, if I do this over the course of 25 trades, 50 trades, 100 trades, 1,000 trades, what do I think the outcome is going to be? So anything can happen, like this trade here, YPF, anything can happen on this trade, but we want to understand the decision-making process for why we are taking the trade there on that shakeout demand tail, why we're taking the trade there, but then we're not basing the quality of the decision for why we were targeting the stock there on the outcome. We're not going, stock was up 10% in 2 days, good decision. Stock was down in 10% in 2 days, bad decision. You don't want to do that. You want to come away from that type of thinking. It's why I can't listen to like football pundits on Sky Sports or anything. They just base their analysis on the outcome, on the score. Like, pointless. You actually want to analyze the game, analyze the process, analyze what teams were trying to do, like analyze the performance, analyze the process, don't analyze the score. It's really, really, really important. So this one here, just something else that you can see as well. Into phase 1 bases, into phase 2 bases is, again, you're trying to follow the footprints of large operators. So sometimes it happens on earnings. This isn't on earnings, but imagine if I just put an E here, just for the purpose of this chart, right? Imagine this is on earnings. So you get a really good sense, and I'm not talking about a biotech stock that has a market cap of 50 million, okay? I'm talking about your bigger boy stocks, okay? If you see an earnings gap up like this on huge relative volume and the RS line goes vertical to the moon, right? You get a big improvement in the RS line, even better if it starts hitting 52-week highs, but you get mega volume coming through on a relative basis. That can be a really good sign. But again, you want to link the concept back to supply and demand. So why does this bar signal there's a lot of buying coming through? What happens? Big gap, open near below the bar, push up, strong close, widespread candlestick. It also then pushes up in subsequent sessions. But remember what I said, okay? Let's just imagine JP Morgan or Fidelity, or let me just go pull this up a second. There's no high quality funds in this. It didn't illustrate my point too well. But imagine that Fidelity, they're not, but imagine that Fidelity are like, okay, YPF, this Argentinian oil and gas company, we want to build a sizable position. We want to have, how many shares are outstanding of this stock? Let's just go here. How many shares are outstanding? Shares in the float. Let's say they want to buy 10% of the float. So they want to buy 18 million shares, okay? They ain't going to buy 18 million shares on a single day. What are they going to do? They're going to time their buys again. Liquidity, perceived value. Liquidity, perceived value. So where are they starting to buy? You got it. Liquidity, perceived value. Liquidity, perceived value. Liquidity, perceived value. Liquidity, okay? They are manipulating, for lack of a better word, they are manipulating, controlling the stock to their advantage. They can, because of the size that they trade. They can do that. So this is why the Richard Wyckoff concept of thinking about all movements in the stock, all movements in the market are being controlled by a single entity. He called it the composite operator. Now, such a thing doesn't exist, but it's a useful framework when you're thinking about the price cycle and you're going, okay, if there was some just large entity, large operator controlling this stock, what are they doing? Are they accumulating it? Are they distributing it? What are they doing? It's a useful mental framework to be working through. Let me just show you a couple of other ones, and then I'll answer a couple of questions. So this one here was a firm. Again, stock that I was targeting. So I was targeting a firm here, and it gapped. So I cancelled the order, and then I would have got filled. Something I need to stop doing, right? Something I'm working on in my own trading. But okay, a firm here. So again, as I said, phase 4. So this stock here, again, you really want to just dial in pattern recognition and go, okay, phase 2 uptrend, phase 3. If you think about when do you want to be long the stock, it's probably not here, right? Phase 4. But then you want to reach the answers of, well, if you're saying, I don't want to be long the stock here, you really need to know, well, why don't you want to be long the stock here? And then have rules in place that help you not be long the stock there and be long the stock where you want to be long the stock. As I said, Bruce Lee quote, absorb what is useful, reject what is useless, add what is essentially your own. So if you add essentially what is your own in terms of your own selling rules, your own selling guidelines for when you want to be involved, when you don't want to be involved, you may have a hard and fast rule that you're like, I am never long a stock below its 200-day moving average. Just never. There's never going to be a stock in my portfolio that I'm long when it's below its 200-day moving average. That may be quite a useful rule to implement. But again, decide that for yourself. But as we start transitioning into this phase 1 base, what you start to notice is a bit of a change of character in terms of the quality of the rallies, potentially the volume coming through as well. The stock then being unable, if we just kind of highlight this, the stock being unable to make lower lows. So instead of making a series of, which is a downtrend, right? Lower low, lower high, lower low, lower high, lower low, lower high, lower lows, lower highs generally. The stop stops. I'm trying to say that 10 times quickly. The stop stops making lower lows. Stops going down. Okay. For some reason, someone, somewhere, and a group of people or a group of funds or volatilities, right? The single entity controlling stock has decided that's enough. That's enough. We see enough liquidity. We see enough perceived value. We're going to start stepping up here. So the stock comes down to potential support. It's always potential support, potential resistance. The stock doesn't have to stop there just because it came down to that price level previously. It doesn't have to stop at $8.63. It doesn't have to. But when it does, now maybe there's something to do there, maybe there's not. That's subject to your identification criteria. But it's just important to know, that's interesting. The stock did not make a lower low and it bounced quite well. What's just happened here is quite the change of character to what was happening here. Now, again, maybe there's something to do, maybe there's nothing to do, but this is subject to your identification process, which you should know like the back of your hand. You should know very specifically what you are looking for a stock to do. Okay, when I do my scanning at night, there's on average probably around a couple of thousand stocks that I look at. I will say no to about 1,999 of them. Just no, 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 no. So if a stock doesn't then meet your stringent setup criteria, move on to the next one. And maybe the next day, the stock has moved into position. But there's no point wasting mental energy on trying to force a trade and trying to see something that's not there. If it's not there, it's not there. Maybe it will be there in a week. Maybe it won't be there in a week. Maybe there'll be a better opportunity. So when you're doing your scanning, which we'll talk about in a couple of weeks' time, whenever we get onto it, it's quite important to get very used to saying no. You're probably going to say no to a couple thousand stocks every single day. Just go, no, 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 no. Okay. No should be one of your favorite words in trading. It should take quite a lot for you to say yes. Like there should be quite a lot of kind of filters in terms of the identification for where you are then going, yep, that's the one I want to target. Out of every opportunity I think that could develop in maybe coming sessions, everything that I'm looking at, this is the one I want to go for. This is the one I want to target. So just fast forwarding a little bit, as I said, just want to kind of keep it focused here on terms of earnings reactions. So when you see this, positive earnings reaction, gap up, widespread, open on the low, strong close, pushes up in subsequent sessions and for subsequent weeks as well. Good to see. RS line improving as well. This is good to see. This is what institutions stepping up and buying looks like, certainly in a stock like this, right? If you do your calculator and go about 87 million times by an average price of $16, let me do it for you. Why don't I do it for you? It's kind of the purpose of these sessions, right? So if we just take the dollar volume on this bar here, let's say 82 million, and let's just times it by an average price of $16. Okay, the dollar volume traded on this earnings bar here is $1.3 billion worth of stock is traded. $1.3 billion. Okay, we're thinking the bigger boys and girls are active. What are they doing? Like, what are they doing? This is what buying looks like. This is what accumulation looks like. So remember earlier on when we were looking at the charts on the weekly charts, like of Crocs, when institutions are rushing for the exits, what does it look like? When institutions are buying hand over fist on an earnings reaction because they love the earnings report, or forward guidance has been raised, or something has happened, okay, and institutions are just buying and they're buying a shed ton, what does it visually look like? Because that can be a really constructive sign if the stock sets up there afterwards. I'm just going to fast forward this stock. Okay, let me just get it here. So again, you then want to go, okay, if I'm going to be in the stock, now what do I know? Because I cancelled the order like a moron, but it is what it is, right? But you then want to be aware of, okay, and this is where your optimizing profits comes in, okay? So what you will see is this price cycle, it'll play out across different timeframes. So if we were to look at this on the monthly chart, what would your assessment be? Well, it looks like it phase 4 downtrend, phase 1, phase 2, still looks kind of early in a phase 2 uptrend, right? If we were to assess this on the weekly chart, what would you think? Well, phase 1, phase 2, this looks a little bit phase 3 distributional toppy, actually. It's lost 10 weeks, some supply shoots, not looking too good. You look on the daily chart, similar assessment, right? You're like, okay, the stock came out, if we color code this. So this will kind of be the crux of the video, and then I'll do two quickly, and then I'll go into your questions that Sam and Adrian have asked. So you've got your phase 1 base in here, okay? You then have your phase 2 uptrend. Let me see if I can go get the trend channel 1. Where's the channel 1 gone? It's around here somewhere. Yep, can't see it. Okay, so here you then have your phase 2 uptrend. Let's maybe make this in a green arrow to signal all is well in the world. And then here, this is going to be your amber, okay? And then here could be your phase 4 downtrend. Maybe the stock does that, maybe it doesn't. That's the Bayesian mentality. You update your decision-making process and new information comes along. We don't have that information right now. I would just say it looks like a very distributional phase 3 top at this moment in time, right? But if you are then going, okay, where do I want to be involved in the stock? Well, if you're thinking about optimizations, so you're thinking about, okay, where would be the best time to trade the stock, assuming that you are an intermediate term swing trader, you're a trend follower of sorts as well. So you're like, okay, yeah, want to use a daily chart. Well, where is the best time to buy it? Well, I would argue the best time to buy it is basically right there where I was trying to buy it. And then if you're thinking about how best could I have optimized the profits, both in terms of monetary gain, but efficiency of the monetary gain, is there anything that I could use to help guide that decision on a consistent basis? So there's 3 main moving averages that you're going to learn in the 4th part, which can be in several months' time, but in terms of optimizing, which is 10-day, 21-day, and 50-day. They're going to be pretty important, but also having in your back pocket the ability to choke the position off by going low the day, 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 if you think it's extended from the 10-day. So the 4 selling guidelines that you're going to learn about in this course is 10-day, 21-day, 50-day, choke them off or all the position, lower the bar, lower the bar, lower the bar, if you think it's extended from the 10-day. Don't worry, we'll cover that all in depth in now a couple of months' time, okay? But then what you want to do is you want to start looking at this. Okay, this is what we're really doing with the price cycle. So this is phase 1. Okay, this over here is 1L. This over here is phase 2. This over here is phase 3. Now, for me, it's pretty darn close from going into a phase 4 downtrend. Doesn't look too good, right? But you then want to assess these stocks. So you want to do things in a very, very, very deliberate manner. Okay, before the stock transitioned from a phase 1 base into a phase 2 base, what did I see? Where was the best setup in terms of controlling risk that you can identify on a consistent basis as a stock is coming out of a phase 1 base and or is in a phase 2 continuation type base? Like, what do you see on a consistent basis? Okay, then we fast forward that. When a stock is trended and this stock has then gone up, and we'll cover this in terms of like the character of the stock's gone up circa 100%, right? Let's just put this at 100%. So the stock's gone up 100%. How did it top out? How did it top out? And you may say, well, price stopped going up. Okay, good. But how did it do it? What do you see happened? So in this part here, because this is really, really important, as I said, the game is in the trade management. Like that's where the game is really, really, really played. Okay, on any one trade, anything can happen. But over 1,000 trades, you, in terms of the trade manager, is going to be a really, really important aspect of this. So as it starts topping out, and when it tops out, and after it's topped out, what do you see? Like, what do you see on a consistent basis? Because this then feeds into your selling rules. Well, you may say, okay, well, I see this big red bar here on high volume. Okay, great. Can you go look at 1,000 other stocks that have high 20-day ADR percentage? And we'll come on to that next week. High 20-day ADR percentages, a liquid, came out of this base here. And then when they were topping, you saw that same behavior, that big red bar there, open on the high, go out on the low, volume pops, 1.5 times only 2 times the 30-bar average. Do you see that a lot? Now, did you see that on 1,001 other ones? And did it close below moving average as well? Well, here it's not closed below moving average. Okay, so maybe it's just an amber signal, but it's something to be mindful of here. Okay, potential change character. There was a lot of selling on this day. And then over here, it starts losing 10 and 21 day EMAs. Now, could we look at 1,001 other stocks and go, well, actually, the 10 and 21 day EMAs in terms of selling rules to help guide your decisions for when you're thinking about optimizing and you're trying to ride that trend as far as it will go, as Ed Scott says in the Whipsaw song. But then look what happened there afterwards. Distribution, 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 which we'd often associate with higher volatility, pops in the volume, lower lows, lower highs, slicing through moving averages as though they didn't even exist. Let me go show you one other one as well. Let me just show you a couple of ones. I'll just load them up. So this one here, you look at ticker S as well, okay? So it comes out of this phase one base. There's a few clues going on in the base around the earnings as well, okay? And it powers out, okay? So similar kind of behavior. Let me just remove all of these. So it powers out here. Let's just go and put this line in here. And then what do you see? Well, it starts slicing below the 10 and the 21, and then it just chops around, doesn't do anything. Okay, this 10 and 21 is looking quite interesting, isn't it? We could go into PLTR as well. PLTR comes out of this big phase one base over here. Let me just zoom into it. Comes out of this big phase one base. Note the reactions to the earnings. Note the reaction to the earnings. And when it starts closing below these 10 and 21s and the 50-day, what does it tend to do? Well, looks pretty phase three choppy, doesn't it? So again, if you're thinking about the optimization here, and you're trying to ride intermediate term trends, you want to be aware of the character of stocks and how they move, because stocks at the end of the day are kind of controlled by the larger operators within them. So when we talk about the character of the stock, I'm not sure when we're going to do that, but we will talk about the character of the stock. You want to look back and assess the character of the stock and get a feel for it and go, okay, how does this stock like to move? When it starts closing below 10-day or 21-day or the 50-day, from these type of setups, from this type of breakout, how does it do it? So just to kind of expand on that point, but link it back to the price cycle a little bit better, you want to understand all stocks are different, like humans. They have different character traits, different personalities. What you're trying to do when you're also assessing the stock, just to kind of, I'll then probably wrap it up off this one, answer your guys' questions, is you want to be aware of the character. So you want to look back at the stock and go, okay, I have an idea of how I'm expecting certain types of stocks to move. I'm open-minded to how this stock wants to move, though, and the behavior of this stock. I will take the stock as I see it. Okay, I have an understanding, have the mental representations. I understand, okay, phase one, phase two, phase three, phase four, all of that stuff, price, volume, relative, yada, 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 right? But I'm open-minded to how the stock wants to move through that lens and how best to trade the stock through that lens as well. So what you may find is when you look back now with new IPOs, it's going to be a lot harder, right? But stocks that have traded for at least a couple of years, you can kind of look back, get a feel for it and go, okay, when this stock likes to set, and you're going to learn about trigger bars, shakeout, demand tails, gap down, reverse bars. When it likes to set up, how does it like to set up? Where does it like to set up? Is there a certain moving average you notice? When this stock then trends higher, how far may this trend go? May it go 10%, 30%, 50%, 100%? We can base that. We can look back at the character of the stock and go, well, here, from the low to the high, about 91%. If we go and take a look at, say, this one over here, where it broke out and really ran, okay, it goes up around about 200%. Here, where it kind of then ran and rolled over, goes up 50-something%. If we were to do the same exercise for Apple over the last 4 years, Apple from these continuation type breakouts is probably not going to go up 194%, probably not going to go up 52%, and probably not going to go up 91%. Because that's just not how it moves in the context of its own phase two uptrend. So this is where you start to understand the character of the stock that you are trading, realizing, okay, how far may this stock go? How does it like to set up? But then we also want to be aware of when this stock stops trending up and it starts transitioning from that phase two uptrend to a phase three distribution top, what does it tend to look like for this stock? Does it end in a really climactic fashion? Does it end by just kind of petering out and just starts closing below moving averages like 10 and 21 days? Maybe it's the 50-day. But then you can also do an assessment. We're getting ahead of ourselves a little bit. But where we're then going to go with it is assessing the stock and going, okay, ahead of time, we're already thinking about the optimization. Ahead of time, we're already thinking about everything. We'll start doing this next week. But we're going, okay, trigger bars, shakeout demand tails, gap down, reverse bars. That's the entry. Here's how we're controlling the risk. Thinking about that relative to 20-day ADR percentages, thinking about the risk mitigation. But then into the optimizing profits, we have an idea of how far the stock may trend. So quite simply, look back at prior breakouts, assuming there's been prior breakouts, and just take an aggregate, just take an average and go, okay, could it realistically go up 80, 90%? Well, it could. It's done that before. There's been some pretty good markets in that time, but it can do that. It's got the character of being able to do that. Okay, so if it could go up 90% and our initial stop loss is 3 or 4%, well, that's quite asymmetric in nature. It's also favorable relative to the 20-day ADR percentage. But then we want to be aware that if we're a trader, there's going to be a point in time in which we're going to sell it. So if there's going to be a point in time, and you're not just going to hold on to this thing for the next 20 years, if there's going to be a point in time that you're a swing trader off of, say, daily charts, weekly charts, and you're going to sell it and you want to optimize the profits, well, we can base those selling rules upon the action of the stock. We can look and go, okay, when this stock transitions from a phase 2 into a phase 3 distributional top, how does it do it? What does it look like? What are the, again, the pattern recognition? What are the characteristics that we associate with that? What is the stock telling us? What are the warning signs the stock is telling us? Okay, now is the end of the intermediate term trend. I'm going to need some time to rebase. It's as though it sounds a little bit esoteric, but we're a bit out there. It's as though the stock is talking to you. Like you're having a conversation with the stock. Sounds a little bit weird. I'll talk to the stocks. Like I'll talk to them. I try and make it a conversation between me and the stock. Say, hey, how do you like to set up? Are you giving me any kind of warning signs here? Are you giving me some kind of tip-offs and some clues I should be looking to get in? Are you giving me tip-offs and clues that I should be looking to get out? Like you're trying to bring the chart to life. You're trying to bring the stock to life. Let it talk to you. Let it speak to you. Sounds a little bit woo-woo, a little bit out there. Maybe I'm a little bit out, but that's how I kind of do it. So it's a useful exercise. So let me answer a couple of your questions. Arthur's saying, I guess the hardest is to guess the moment when the stock from distribution goes back into accumulation cycle to not miss the ride. I don't think that is Arthur, because so I'll now spend some time, 5-10 minutes or so, answering these questions. So let me just put them across so you guys can then see them. So Arthur's saying, I guess the hardest is to guess the moment when the stock goes from distribution, goes back to into accumulation cycle to not miss the ride. Well, it links back to your identification. Where are you looking to buy the stock? Like, how do you identify a setup? So it's not hard at all. It's maybe hard if like you are trying to pinpoint the exact time where the stock stops going down and turns around. But then again, even if you could pinpoint the time whereby the stock stops going down and starts going back up, right? So let's say you pinpoint it and you get in right there. That's extremely difficult to do. You're not going to be able to do it. But the point that I'm making is it even optimal? Is that the best thing to do? Like number one, you can't identify that. Like hindsight 2020, where it's easy, you just look and go, oh yeah, it's there. Well, okay. But then how would you then even manage that? Do you see what I mean? I know I'm being really like black and white and direct, but that's just kind of me as well. That you look at it and you go, there's no repeatable setup there. Like you cannot identify that. There are no common characteristics to that. In hindsight, you can look back and start to see, okay, yeah, change character is going on there, but how on earth do you identify that? You can't. How do you control the risk? Extremely difficult. How do you mitigate the risk? Well, you could just sell it like 1 times your initial stop loss, wherever that may be. But again, it's difficult. It's not really thought out. But then if you're buying here, how do you optimize the profits? What are the if you're buying that, how do you optimize the profits? What are the selling rules? What are the selling guidelines that you're using? So when you then think, I guess the hardest part is to guess the moment when stock from distribution goes back into the accumulation cycle to not miss the ride. Well, the time to get in the stock was then like here, where it was setting up and trying to come out of this space. Like, are you going to sit in the stock from May 2022 for 12 months? And there's no reason. Imagine if you'd thought that there and then the stock's down 50%. So that's not the difficult part, because you're not trying to do that. Like, that's extremely difficult. It's nigh on impossible to do that on a consistent basis. You're not trying to do that. You're trying to do things on a consistent basis. So then what you're trying to do is identify certain setups, certain things that tend to happen. So you're trying to follow the footprints and go, okay, shakeout demand tails, gap down, reverse bars, trigger bars, continuation type basis after positive earnings reaction. The stock is in an uptrend. It's coming back out. So, I'm saying, yeah, I see your point. I guess it goes back to checking moving averages like 200-day, 50-day for guidance. Yeah. And this is what we'll then do in the next three, which is trigger bars, shakeout, demand tails, gap down, reverse bars. We will go really, really deep in terms of the specific identification criteria. I will show you what I think tends to happen time and time and time again and where I think the best entry points are. You may reach a different conclusion, which is absolutely fine. You reaching a different conclusion isn't going to change what I do. I like what I do. But if you reach a different conclusion, if you look at everything and you go, actually, I'm going to add what is essentially my own. I found some information that is useful, but now I'm going to add my kind of own kind of thing to this. That is absolutely fantastic. And I really, really, really encourage that. I have studied everyone you could possibly study in the stock market. I have, I don't know, 500 books. All the, I don't know, I've probably spent at least 10,000 hours studying other people and then tens of thousands of hours in terms of my own study. So I studied like everything else and I took golden nuggets. What I would encourage you to do with like this course, and as we go and we do kind of a different segment each week, take a couple of golden nuggets and go, I really like that. That other thing, it was useless. I don't. And if you find it useless, that's fine. It just may not meet your personality. It doesn't match your personality. But if you find like a little golden nugget and you're like, I really like that, I'm going to implement that into my. That's what I did, right? You basically just kind of learn everything there is to learn out there. Okay, piece it all together, shake it all out, and develop something that suits your personality. Let me answer a couple of other questions. So let me just put them in. I'll put them into the notepad as it's a little bit easier. So, question here by Sam. Let me just bring it across. Hi Jack, I hope you're well. I'm struggling with the mitigation process, specifically when using the interactive brokers. I use self-stop with a stop loss all the time. Problem is taking as soon as I mitigate, there is a methodology. Okay, I'll answer that one in Friday's live coaching session where we do the Q&A. I will do that for that one, and then I'll make a copy of it. And then let me just answer Adrian's, which is this one. Hello, Jack. I want to ask if you think it's more appropriate to trade only the weekly time frame, because in my opinion, there is less painful and also eliminates micromanagement. Thank you for your time and answers. So that there, Adrian, is you adding what is essentially your own. So if you prefer the weekly charts, if you prefer trading off of the weekly charts, trade off of the weekly charts. But again, it's got to match your personality. The principles, in my view, are the same. Like a good setup on the daily chart from a supply and demand perspective kind of matches the setup criteria on a weekly chart. You've got to be aware that on a weekly chart, there's going to be a lot less trade. So the higher time frame that you go up, the less trading signals you are going to have. That's just a fact. If you're trading on the 1 minute chart and you're an intraday scalper, you're going to have a lot of trading signals as per your criteria, as per your identification criteria. 5 minute chart, well, there's still going to be a lot, but probably less than the 1 minute chart. The 1 hour chart relative to the 5 minute chart, less trades. Daily chart compared to the 1 hour chart, less trades. Weekly chart relative to the daily chart, less trades. So it then fits in with you and your kind of daily systems and routines. How many trades are you looking to take? How are you trying to construct your process? So you start thinking about your process and going, okay, identify, control, mitigate, and optimize. How many trades do I want to be taking? What time frame suits me best? What time frame suits me best in terms of the management side of things? And a conclusion that you may reach is you may go, well, you know what? I quite like using the daily time frame. And I've got a question that I'm going to answer in Friday's live coaching session in terms of risk mitigation tactics on the weekly chart. You may go, Adrian, well, you know what? I like the daily time frame. I like the weekly time frame as kind of my bigger picture, and I like it to manage things off of. So in terms of the trade management, you like using the weekly chart, just removes a lot of noise. Potentially it suits in with your kind of day-to-day routine as well. Family, work, life, things like that. You're like, I don't want to be looking at charts 1 hour a day. I don't want to do it. That's absolutely fine. But that's then got to feed into your process and how you go about optimizing the profits. So whether you're trading off the daily chart or the 1 hour chart, you still got to be thinking about optimizing the profits, controlling risk mitigation, things like that. So what you may do is find a sweet spot is actually, I like looking at the weekly charts. I think it gives me a pretty clear view of things. I like managing the trades off the weekly chart, removes a lot of noise. I don't have to look at it, worry too much about day-to-day kind of price fluctuations. But I want to bring in the daily chart just in terms of that kind of initial entry point, help me tighten up the risk a little bit. So what you may find with your process, and again, this is the Bruce Lee quote, absorb what is useful, reject what is useless, add what is essentially your aim. So you may start to tweak things to make things suit your personality and go, right, okay, yeah, weekly chart, that's where I'm looking for the setups, but I do like to drop it onto the daily chart because there's a couple of things that I like to see. I like using the daily chart to help get tighter risk control. Oftentimes your initial stop loss on the weekly chart, if you're going higher the week, lower the week, your initial stop loss, this is pretty tight on a weekly chart, but it is going to be closer to kind of your O'Neill 7 or 8%. Maybe you're comfortable with that much risk, maybe you're not comfortable with that much risk. Maybe you realize that when you see a really good setup on the weekly chart, you could go down onto the daily chart and you could get that initial stop loss down from 7, 8% to 3%, 4%. Okay, maybe you want to do that, maybe you don't. So then you're bringing in the daily chart early on in the trade, but as soon as you've then mitigated the risk, you get rid of the daily chart and you're just managing it off the weekly chart. That's kind of what I do in terms of using the daily chart and the 1 hour chart. Okay, so I'll use the daily chart in terms of like my anchor for where I'm looking for types of setups I want to target, but I will utilize the 1 hour chart to help me control risk, mitigate risk, but then I'm not managing the trade off of the 1 hour chart. I'll make 101 mistakes during that. So do you see how you can utilize, so oftentimes it's not an all or nothing thing. Use different time frames that best suit you. So did I answer the question? Let me just read it again. I want to ask if you think it's more appropriate to trade only on, I think I answered that. I think much depends on you and not just an all or nothing. Like for me, I think a lot of people are better traders utilizing multiple timeframes. Now, oftentimes that only needs to be two: weekly chart, daily chart, 1 hour chart. For me, kind of use 4. I would say I kind of use like 5 actually. The monthly chart, but I use it less frequently. I just want to be aware of longer term trends. The weekly chart, but again, I use it less often than the daily chart. But the daily chart and the 1 hour chart, I will spend 90% of my screen time there. And then sometimes I'll take a look at the 15-minute chart as well, just get a little bit of a feel for things, intraday action, when I'm then kind of analyzing a chart as well for a setup. I look at the 1 hour, look at the 15-minute, try and get a bit of a feel for things. So anyway, hopefully that answers that question. Sam's question, I will answer that in Friday's Q&A video for you. So I'll do that. But yeah, hopefully that was useful, guys. So as I said, the next one that we do will be next week, just to kind of conclude this one. So that was all about the price cycle, which underpins everything. Like this is the foundation, everything builds upon this. Like everything from the process standpoint builds upon this. Okay, phase 1, phase 2, phase 3, phase 4, everything is built upon this in terms of where you're looking to identify setups, how you're looking to control risk, how you're looking to mitigate risk, and then just finally, if I bring this across here, finally, okay, you're then thinking about, okay, this price cycle, I've then got to be aware of, okay, say this is a moving average, and say this is a moving average here, I then need to be aware of how I'm then looking to optimize profits within the context of this price cycle. So it's both identify, okay, and control and mitigate, but then also optimization within the context of this price cycle. Where are you looking to mitigate risk? Optimize profit, sorry, to ride the trends. So next Tuesday, we're going to be doing trigger bars. Hopefully we can do it in a single session. I'll try and keep these to one session, but this is the format we're going to be going through. So it'll be trigger bars, then shakeout demand tails, then gap down reverse bars, then the 3 types of stocks to trade. So TMLs, momentum leaders, group theme leaders, and we will just be working our way through this. When we have then gone through all of it in about 30 weeks time, we'll cycle back through, I'll add some new material, and we'll go gadget again, basically, as I think it'll be good to do that. So yeah, thank you very much for joining me, guys. Hopefully it was useful. Hopefully I didn't bore you too much. So next Tuesday, it's going to be trigger bars. Thank you very much for joining me. Appreciate it, and I will see you in the next one. Thanks, Alpha. Hey guys, hope you and your families are doing well. This is the live coaching session. Today's date is the 16th of April 2024. So we're going to continue with the blueprint trading course, and we are now in section 1 in identify, but we are 1.1, and this video is going to be all about trigger bars. So in the space of 30 minutes, 40 minutes of kind of coaching and teaching, I'm going to try and teach you everything I know about trigger bars and try and get across the main concepts. And then kind of in the second part of this live coaching session, we're going to do some bar by bar deliberate practice, going to throw in a couple of nuances as well. We'll add a couple of things in for you can see these type of trigger bars in different areas of the price cycle that we did last week. So some of them are going to be in your excuse me, in your phase 2 uptrend, some of them are going to be in your phase 1 basis. So let's jump straight on into it. Hopefully this green mouse is going to work a little bit better. So let me scroll down here. I'll make all of these slides available once we finish the course in 30 weeks or something like that. So it'll probably be many hundreds of pages. But let's start off here, okay? Just basics, okay? So where are we actually looking for trigger bars? And we'll come on to what trigger bars look like on the next slide. But where are we actually looking for trigger bars? So within the context of common chart patterns that are in uptrends and ideally near one or more key moving averages. So the key moving averages where I'm going to really be looking for trigger bars, shakeout to martels, gap down reverse bars is going to be 10-day EMAs, excuse me, 10-day EMAs, 21-day EMAs, and 50-day simple period moving averages. So it can be around one or more of those. Sometimes you can get a nice clustering of, say, the 10-day and the 21-day. Sometimes you can get a nice clustering of all three of those moving averages, including the 50-day. That'll be more so on a bigger base. But the common chart patterns that you are going to see, there's a lot of kind of fancy names out there, but the way I think about them is flags, triangles, pennants, cup with handles, wedges, and a flat base, also known as a Darvis box. What you will note though, okay, is the textbook breakout point is often not the entry point with trigger bars. I'll say that again. The textbook breakout point is often not the entry point with trigger bars, and it's not unusual for multiple trigger bars to occur within continuation type bases. So as you're going to see with shakeout to martels, gap down reverse bars, trigger bars, it's often not this point here. Hopefully you guys can kind of see that, see that okay where I'm kind of pointing. Should I put the spotlight on it as well? There we go. That probably makes it even more clear, certainly for the kind of video as well. So you see this here. This will be kind of your textbook breakout point. Okay, let's do a cup and handle because you're probably super duper familiar with cup and handles, right? So you see this here. This is kind of your classic breakout point. But oftentimes with trigger bars aren't occurring there. Shakeout to martels aren't occurring there. Gap down reverse bars are occurring there. Sometimes they are, but it's more so going to be these spots here around these little kind of higher lows, kind of like pulling into a moving average. So it could be here, it could be here, it could be here, it could be down here as you're kind of transitioning out from the cup to the handle. These kind of spots here. This is why I'm really kind of like dialed in and trying to focus. So what on earth does a trigger bar look like? Well, let me just read this out to you, okay? So trigger bars can be tight low volume inside candlesticks near one or more key moving average. However, they do not have to be inside candlesticks. They should be tight relative candlesticks in the context of powerful uptrends and or continuation type bases. Trigger bars can often look like narrower range shakeout to martels and gap down reversals. The percentage range of the daily trigger bar candlestick from high to low versus the stock's 20-day ADR percentage in the better cases is often 1/2 to 2/3. This helps to control risk, as we'll talk about a little bit later. Another nuance is the trigger bar candlestick can often have the tightest daily range seen within prior weeks. Bonus if this occurs on low relative volume versus the 30-day average volume. I'll explain why when we start thinking about the supply and demand dynamics of trigger bars in a couple of minutes. The trigger bar real body of the candlesticks does not have to be green, albeit that is a better indication of strength. The key element is relative tightness and constructive price volume action prior in a leading stock. So you'll be starting to get familiar with these candlesticks. Some of you guys who've been around for a little while will know about these. So this is a shakeout to martel, but then what I'm pointing to with the black arrow, this here is going to be, just get this one again. This here is then going to be your trigger bar. Okay, so this here is a trigger bar. This here could be, say, a gap down reverse bar. Then you get a trigger bar. This one here, you got a shakeout to martel, followed by a gap down reverse bar, then followed by the trigger bar. So in all of these examples, they're inside bars, but don't have to be an inside bar. Here you actually could potentially get back-to-back gap down reverse bars, and then this trigger bar coming through. So this is often what it will look like, but it's also important to think about constructive price action leading up to that. So let me just give you another kind of high level overview here. I'll tell you what, for brevity's sake, I'm not going to read this whole slide out to you. When the recording comes out, feel free to pause this slide. This is going to be the stuff that I'm going to be talking about for the remainder of the session. So when the recording comes out, if you want to read all of this, but I'll save us 5 minutes here, and I will jump ahead. So let's start actually looking at some examples. So what I'm going to do is show you a couple in terms of the trade layout as well. Now these are textbook. These are as textbook can possibly be type trigger bar setups. What you'll also find is you may be familiar with the work of Toby Crabell, who's a billionaire hedge fund manager, and he still does as far as I'm aware, but he had a setup called 2-bar and 3-bar NR, which is basically where you are looking for the narrowest 2-bar range or the narrowest 3-bar range over the last 20 trading sessions or days if you're trading something that it's like 24 hours. But you're basically looking for these areas of extreme contraction. Now this is just the way the market moves. The market moves from periods of contraction to expansion, and from expansion back to contraction. It's just the way the market moves. So oftentimes your kind of best of the best trigger bar type setups from the continuation type bases, flags, pennants, wedges, things like that can actually be 2-bar and 3-bar NRs. We get really, really narrow ranges relative to the last 20 days. Could be 10 days, 20 days, 30 days of price action, but 20 days is just a nice metric. So what you are looking for, we'll dive a little bit deeper on our Cyrus Logic one, okay? What you can see here is the stock is in an uptrend. Now it's starting to respect. As it starts basing, this is a subtlety, but it's super duper important, okay? So it starts building this base. You kind of have one contraction, kind of two contraction here, and then it really starts tightening over here. So this bar that you see that I'm pointing to with the black arrow is the trigger bar. So this in a nutshell is trigger bars, okay? But as this base is building, so when you are looking for these wedges, these pennants, VCPs, ascending triangles, symmetrical triangles, Darvis boxes, covenant, whatever you want to call them, right? What you'll tend to find in terms of the better selections is they will respect certain moving averages. Now, oftentimes the 10-day EMA is going to be too quick. Okay, when you're looking for these type of setups, trigger bars, shakeout demand tails, gap down reverse bars, as you're going to learn about in coming weeks, the 10-day EMA for a lot of stocks is going to be too quick. We are going to go into, in a couple of lessons time, about the type of stocks. So we're going to talk about TMLs, true market leaders, we're going to talk about momentum leaders, and we're going to talk about group theme leaders. For pretty much everything other than the highest quality true market leaders and your momentum leaders, the 10-day EMA is likely going to be too quick until the stock starts basing. So what you'd like to see is these bases build, as these flags, these pennants, these wedges, these Darvis boxes, these cup and handles build, is the stock to find supportive action around certain moving averages. So the key one, if you're going to focus on one, I think the key one is going to be the blue line, which for me is the 21-day EMA. That's going to be a nice sweet spot. So what we can see here with Cyrus Logic, you're going to learn about this is a shakeout demand tail off the 21. Here, it then puts in a little kind of shakeout demand tail, gap down reverse bar off the 21. Then in the second half, it really starts tightening. So what you're then looking for is a really tight bar in the context of, i.e. a nice continuation type base. One of those ones I just mentioned. Flags, pennants, wedges, VCPs, all of that stuff, right? You're looking for these really tight bars, ideally on one or more key moving average, okay? On one or more key moving average. Now, why would I say one or more key moving average and in the context of the proper base? Because if you look at this here, if I go and use some of these tools over here, right? If I go and circle this bar here, this bar does not look dissimilar to the bar that we're pointing at and looking at over here in the trigger bar. But it's the context. This is what hopefully you'll get a lot out of this kind of like trading course. It's the context, okay? It's not just what's happening, but where is it happening? Okay, it's not just what's happening, but where is it happening? So just having that rule that you're looking for, okay, some form of continuation type base or a really strong uptrend and it's like pulling back into, say, the 21-day EMA for a lot of stocks, maybe the 50-day, but these continuation type bases, and then you see a shakeout demand tail, a gap down reverse bar, or in this instance here, the trigger bar, but around the one or more key moving average just helps to stop chasing extended stocks, because ideally, you'd like to get your initial stop loss underneath the 10-day EMA. The trigger bars, shakeout demand tails, gap down reverse bars. Certainly more so for like shakeout demand tails and gap down reverse bars. Sometimes trigger bars can be sitting just above it in terms of initial stop loss placement, but it just helps stop chasing extended stocks. So you're like, wow, just seeing the trigger bar. This is a trigger bar. Yeah, but it's not basing, and the stock's just run up 4 days and it's extended from the 10-day. That's not the time to be looking for a trigger bar. This is the time to be looking for a trigger bar. So if we do a couple of reps and sets, as Arnold would say, hopefully it'll start making a little bit more sense. So let me just clear all those drawings. So again, first majestic here, we see the stock is in a nice uptrend. And what you'll find as we go through here, it's not about pretty lines on a chart. Okay, when you're looking at this, it's not about you can draw kind of a perfect channel and this happened. What matters far more than drawing some pretty lines on a chart is what is happening from a supply and demand perspective. Really what we're trying to do here when you start thinking about trigger bars, you start thinking about shakeout demand tails and gap down reverse bars is what is happening from a supply and demand perspective is going to be really, really, really important. So as AG here, this is a precious metal stock, starts pulling back down, you get this inside bar. So you get, see how it bounces off the 21 here, gets a shakeout demand tail, tightens up here, really tight bar, low relative volume coming through. It's really, really, really good behavior to be seeing. Okay, so this here, and then 1 time's to stop, 2 times. We'll do that in the live coaching session a little bit later on. Let me just play this one forward here. So we're going to A and D. I'll be a little bit quicker on these. I think I'll just kind of point to these now, and then we'll start doing a lot of it in the bar by bar stuff. So something that you'll train your eyes to, and certainly when we've done like trigger bars and shake out demand tails, is starting to think in terms of what am I then seeing inside the base. So what you can see in the middle of this base here for A and D is what is a gap down reversal bar. So the price gaps down, opens on the low of this bar, and then pushes up, strong close, and then you get the trigger bar. So you see how tight the bar is, and oftentimes the trigger bar itself can be on the lowest relative volume. Really, really good sign to be seeing. Let me go forward to another one as well. So this is Oracle. We'll bring in relative strength here as well. So we see Oracle. Let me just draw some pretty lines on this base. Okay, so Oracle is basing, it's a bit more of like a Davis box-esque, isn't it? But you see how the volume just really dries up here. Okay, this black line that you see running across the volume is the 30 bar average. Let me go get the spotlight as well. There we go. So it's the 30 bar average. So we have low relative volume, but you see this here. This is the relative strength line. It's a free tool. Search my name on TradingView and you'll be able to find it. See how Oracle goes and puts in this really tight relative bar. So tightness on a relative basis. We're looking at what is tight for Oracle based on Oracle's behavior. We're not looking at Oracle based to some biotech stock or some solar stock or some EV stock. No, we're keeping it apples and apples, oranges and oranges, pears and pears. So what you can see here is it puts in a really tight bar and it hits a 52-week high on the relative strength line. So what this means is the stock is hitting 52-week highs pre-base. See the 52-week highs? Hitting 52-week highs pre-base. It's a leader. 52-week high, these blue dots mean it's a leader. The stock starts basing, and then on the trigger bar, you get this 52-week high, this blue dot. Now, this is going to be a very, very important concept when we're thinking about trigger bars, shakeout demand tails, and gap down reverse bars. If as the stock is basing and it builds one of those optimal continuation type bases, if on one of those three candlesticks, it then, and they're in the proper context of where they are forming, you get a blue dot forming on the relative strength line and the stock is still within the base. For me, I think that is one of the strongest signs of strength you can possibly see. So blue dot on one of those candlesticks, thumbs up kind of thing, right? Really, really good to see. And if we just talk about tightness on a relative basis, the 20-day ADR percentage of the stock is 2.13%. So that means over the last 20 days, the average daily range percentage of the stock, so from low of the day to the high of the day, excluding gaps, is 2.13%. Whereas we can see with the range of Oracle, it's 0.75%. So this is how we then start thinking about creating asymmetric risk versus reward trading opportunities with some of these. We'll do this a little bit more in the bar by bar stuff in the second half. Just want to dial your pattern recognition into, okay, what does a trigger bar look like? Where am I looking for it? So with pins here, right? We'll bring in a little bit of a nuance, okay? So we can see, here's the trigger bar, very tight bar, initial stop loss target through the high, stop underneath the low, 1.15% off an ADR of 2.63%. We like that, very nice. You can also see, look how low the volume is. So when you get these trigger bars, so the range of the bar is really tight and the volume is very low on a relative basis. Black line, 30 bar average, okay? What is this telling you? Well, what you've had is a really good reaction to the earnings. So see, this is an earnings gap up there. And then what you can see is as this is building here, this is something to just dial in, ingrain inside of your brain. That rhymes, doesn't it? Ingrain inside of your brain is multiple tight candlesticks on low relative volume are an indication that there is absorption of supply and not much supply that is coming to market for this stock. So tightness in price like this on low relative volume can indicate in the proper context, there's not a lot of supply. There's not a lot of selling. That's what we like to see with these trigger bars. The trigger bar, for me, is kind of that final piece of the proverbial jigsaw puzzle that says, hey, there ain't much selling, there ain't much supply around for this stock. There's kind of been an equilibrium that has been reached. Strong hands have moved in, weak hands have moved out. This stock is now ready to go higher. Like it's that final piece of the jigsaw where my expectation is this stock should now start going because we've seen evidence that there isn't much supply for this stock. On this bar here, is targeting pins through the high here. Low relative volume, great reaction to the earnings. What do you think the big boys and girls are doing here? Multiple tight candlesticks, low relative volume, 52-week highs in the base. RS line holds up very well. There's just absorption of supply post earnings. So again, it's not just what do you see, it's the context of where do you see it. You see this about 20 bars or so after the earnings gap up, find supportive action on the 10-day. Very strong stock in indeed. Let me take you through onto the next one, which is going to be about trigger bars and basically timeless. So here you go. This is the weekly chart. I've got about 7 charts now, which are going to be on the weekly charts and take you way back when in time. Okay, so this is the Dow Jones hit. So you'll see these trigger bars form on all time frames. A little bit later on, we're actually going to do a bar by bar on a 1-hour chart of a new IPO, just to kind of illustrate the point, right? But this here is the Dow Jones in 1904 on the weekly chart. And what bar do you see here? Okay, what bar do you see? Let me go get my pointer like this. There we go. What bar do you see there? is a very tight bar. It's an inside candlestick. And do you know what chart pattern it also forms? Those of you who read, say, Minervini's book will be on. It's a VCP. It's also an ascending triangle. One contraction, two contraction, three contraction. So the Dow Jones here, not only is it building high lows, which is structurally bullish, but it really starts tightening here. And you see the decrease in price volatility as it's forming this base, and it's a continuation type base. So it's not uncommon, and it's very common to see this tightness in price occur as the final part of the proverbial jigsaw puzzle before the stock starts transitioning out of the base. It's a really, really, really constructive sign to see. So you'll see this on the weekly charts, the 1 minute chart, the daily chart. You'll see it from 100 years ago. You'll see it from 100 years from now if we're all still here, right? I just think it's a really, really constructive sign to see, and it can help create those more asymmetric risk versus reward trading opportunities. Dow Jones again, if I go forward one more slide. Here we go. Let's press the down button. Let's move down. There we go, like this. So this is the Dow Jones around about 23 years later, okay? 1927. What chart pattern do you see? That's another ascending triangle. Right. BCP, right? You have one contraction, two contraction, three contraction, four contraction, and you see how it starts tightening. So high lows, tightness in price. Imagine that the volume is just dried way up here as well. It's just an indication of there's not much supply. So this can be a very constructive sign, not only on an individual stock basis, but if you're, say, looking at a group ETF or a theme ETF. So a theme ETF may be, say, EV stocks or AI stocks. The group ETF may be semiconductor stocks. It may be solar stocks. It may be oil and gas stocks, uranium stocks. Okay. If you start seeing behavior like this in the group or the theme ETF, and you're like, wow, okay, it's building a multi-week base, a multi-month base, a multi-year base. Now I'm starting to see tightness in terms of the group, the theme ETF, and then you drop it down onto an individual stock basis and you see constructive behavior as well. That can be quite a powerful situation to find yourself in. So let's clear these, and now we'll start going through a couple of other historic examples. So the next five examples, these are going to be from William O'Neill's book. So if you haven't read How to Make Money in Stocks by William O'Neill, well worth reading. I think the first 100 pages of the book are basically charts. So what I'd suggest doing is, after the next 3 weeks, when you have seen trigger bars, shakeout demand tails, and gap down reversal bars, have another read through if you haven't read it already, or if you already have read it. Read it again, the William O'Neill book, and just read the first 100 pages and look at the historical charts. What do you see? Now, this is the key part. What do you see that keeps happening? I'm teaching you what I think. This keeps happening. This keeps happening. So if you take a look at Bethlehem Steel, those of you who have read Reminiscences of a Stock Operator, Jesse Livermore book, will be familiar with Livermore talking about Bethlehem Steel. Over 100 years ago, nearly 110 years ago, right? Think about this. This is 1915. And this is why it's timeless. It's just supply and demand. What is supply and demand? It's buying and selling. Buying and selling, accumulation, distribution in the stock market has never ended, and it is never going to end. This is why I think you'll just see this continue to play out as large operators accumulate positions and then they distribute positions. Then they accumulate other positions and they distribute that position. It's just what happens. It's how the game is played. But if you see here, right, let me just go and point to it like this. Do you see this here? Look at the tightness in price. So this is actually a high tight flag pattern, and this will be the volume, the average volume. I think this may be 50-week average volume, so 50 bar average volume instead of 30. I think it will either be 30 or 50, but the point is here, see how the volume dries up and the tightness in price. So a dry up in volume, tightness in price indicates what about supply? There's not a lot of it. In the context of a proper continuation type base, like here, trading tights, little Davis box, high tight flag as well, it's really, really, really good to see. Really, really, really good to see. So this is Bethlehem, nearly 110 years ago. It's the same thing that just keeps happening. You will see the patterns that keep on occurring. Now, I do just want to make a point here. Have you read the Nicholas Davis book, how he made a couple of million in the stock market? If you have, you may be familiar with this stock here, E.L. Bruce. Do you remember it? E.L. Bruce. He's walking around Paris with a little piece of paper that says on it, "Remember Bruce." This was one of his really big winners in the market when he went on a really big run. Here's a chart of it, E.L. Bruce. So then he had another one. I can't remember the name of the other one off the top of my head. But he had a bit of paper in his pocket. It's a nice situation to find yourself in. You have a really big winner that's giving you no reason to sell it. And what he did is he didn't want to exit prematurely. So he carried around a little bit of paper where he wrote on it, "Remember Bruce," being this stock here, okay? Remember Bruce. So this is something that's really good to see. You're going to see it in present day when we look at earnings reactions, but also when you look in the 1950s, okay? It's the concept of bullish synchronicity, which is widespread candlesticks being confirmed by the volume. So they open near the low of the bar. This could be weekly bars, daily bars, 1 hour bars, but they open near the low of the bar, close near the high of the bar, and they're wide on a relative basis, and there is large relative volume. Why? What's that an indication of? There's a lot of buying. There's a lot of demand for the stock. So ideally, you see this type of behavior, like 1, 2, 3, 4 weeks up here. Look at the volume coming through. Then it goes and builds an optimal continuation type base. This one here on the weekly chart doesn't put in a trigger bar as such. Maybe it did on the daily chart. I don't know. I don't have the information for that. But a point I'm trying to make here is this is really good to see. Ideally, before these continuation type bases form, you see a lot of buying. How do you visually see buying? Widespread candlesticks, high relative volume, strong closes. That is what you are looking for. So let's go here. This is Zenith on the weekly chart. I think Darvis was in Zenith, you know. But this one here, okay, this red line that you see, this is going to be the 10-week SMA, which at this moment in time, quite a lot of leading stocks are around their 10-week. Interesting, right? Leading stocks will revisit their 10-week multiple times during their run-up. But what do you see? Right, I'm going to be a bit quicker here. But what I've just tried to point to is look at the tight candlesticks, and it's where are they happening? Key moving average, 10-week simple period moving average, very closely aligned with the 50-day simple period moving average. So look at these ones here. See, I get this inside week, low relative volume. Here, quasi inside week, really low relative volume. So it pulls down to the 10-week little bounce, and then it tightens. Okay, so you want to be aware of these on the weekly charts, the daily charts, but think in terms of this, why we started this course with the price cycle. It is the foundation, okay? Powerful phase 2 uptrends, phase 1 bases as stock is looking to come out, but it's not just what's happening, it's where it's happening. Context, 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 really, really important. Universal controls, 1950s. Again, see the tightness in price that comes through, see the tightness in price that comes through. It's just time that you'll just continue to see the same thing. American chain and cable back in the 1930s. See, I get this inside week before it comes out of the base. See here, before it comes out of the base, the inside week. It's just timeless. You'll just continue to see these things. It is literally supply and demand. It's all it is. It's nothing fancy. I'm going to whiz you through a couple of setups now. So this is just to dial in the pattern recognition. I would suggest if you want to kind of go and study these a little bit more, is just pause the video, have TradingView or TCTI or whatever your charting platform is. I think TradingView is the best for this kind of analysis. But you can go back and you can study the stocks for yourself. So you see KEX here. Okay, this is back in the 1980s. We're going through in chronological order. Something that's really important to dial your pattern recognition into is you see the 52-week highs. Let me get the pointer as well. You see the 52-week highs. So something that is fantastic to see. We're not even talking about the chart here as such. We will. But you see this here, the relative strength line, okay? We want to try and identify leadership wherever we can try and identify leadership. There's always leadership in the market. Now, leadership is transitory. It will change. Sometimes you will see leadership in EVs. Sometimes it'll be solar stocks. Sometimes it'll be oil and gas stocks. Sometimes it'll be semis. Sometimes it'll be software. Sometimes it can be several groups at once. It moves and it changes and it wiggles and jiggles. But if you stay focused on relative strength, that is where I think the smart money is going. That is where the better operators in the market are going, who are seeking outperformance. Okay, they need to outperform their benchmark, oftentimes the S&P 500. So they need to be in the stocks that are showing outperformance to the benchmark. Otherwise, they lose their assets under management. They get sacked. So this is why the institutions go where the relative strength is. Now, we're also going to talk about type of stocks as well in a couple of weeks' time, because it's also important to think, if you're a big institution, you have billions and billions and billions in terms of assets under management, you are limited to the type of stocks you can buy. Because of your size, you need the liquidity there. So this is not only where you're trying to identify relative strength, but you're also, we're getting ahead of ourselves a little bit, you're also trying to think, where are the institutions going? Where are the mutual funds? Where are the pension funds? Where are Fidelity? Where are JP Morgan going to be forced to go because of their size? If we're seeing leadership here, where are they going to be forced to go? But a really, really, really good sign is 52-week highs on a relative strength line, pre-base, in the base. You see that in the base. This is hitting multiple 52-week highs and post-base. So if you can identify 52-week highs, pre-base, in the base, post-base, you could be onto a really, really, really powerful stock. Really powerful stock. But look at the tightness, look at the dry up in the volume, look at the 352-week highs in a row. So these 352-week highs in a row, what do you think the market is doing? This stock goes nowhere. The stock basically goes sideways for 3 sessions. What do you think the market did during that time? Those 3 sessions, the market did this. The market went down and the stock went, no. I'm going to hang on in here. Somewhere, someone, somewhere, for some reason, was supporting this stock. We don't know why. Can't go and ask everyone. We can't take out a clipboard and go and ask them. The important thing is the reality of the situation. They did. They did support the stock for whatever reason. So it's about dealing in facts, about dealing in reality. Let's play this forward. I'll be a bit quicker on these ones. Okay, HP, September 1980. So the stock starts basing. Let me go and get this one. Here, like this, stock starts basing one contraction, two contraction. See the tightness that comes through. Now, the volume doesn't always have to drop below the 30 bar average on a trigger bar. If you get a little pop in the volume and say it's 30 bar average, a bit above, but you get this really tight candlestick, it can be absorption of supply. We're going to take a look at one of those later with WEAV, where you get a pop in the volume on a trigger bar, but then when you look intraday, so we'll bring in multiple time frame analysis, you can see there's signs, mental representations that we would associate with absorption of supply. KEX again. 52-week highs, pre-base, in the base, post-base. Really, really, really good to see the stock here goes up 30%. You can see on that chart from $10, $13. That would be split adjusted 101 times now. But 30% in the space of 6 sessions, 7 sessions. Not bad, not bad. OLN as well. So see the tightness, see how the volume dries up. Oftentimes it can be the final piece of the jigsaw puzzle before the stock comes out of the base. It can just be a good indication to get, yeah, this is really tight. Something that's useful here. Okay, you have AN. Being aware of a catalyst is sometimes important. So what you can see here for this stock is there is a powerful move up here. The stock goes from, let's call it $2 to about $7 in short order, right? A couple of weeks. And there's a big increase in the volume coming through and the relative strength line starts moving up as you'd expect when a stock does that. So being aware of a catalyst, a fundamental catalyst, maybe this company is just, if it's a biotech, I don't really like biotechs, maybe it just got FDA approval for a phase 3 drug and they're going to be able to monetize it in the space of 6 months. So, okay, the market is adapting to new information. Maybe the company has just brought out a new product. So say like Apple with iTunes or the iPod or the iPhone, something like that, right? It can be those kind of things. Maybe say like Tesla in a couple of years time, Tesla brings out a Model 2 that they're selling for 25 grand or something like that. And then suddenly you see, well, the market really, really, really like that. So again, what really drives share prices higher in the long term is earnings and perceived future earnings. That's what really drives these things higher. So you do want to have a little bit of common sense, try and understand the story, understand the fundamentals to an extent. For me, I don't like to know too much, but I like to know enough, if that makes sense. And then you can see here, okay, where does it start finding support of action? Well, around 10 days and 21-day EMAs, and then you get this real tightness here. But as I said, you can get multiple trigger bars. So this is why in terms of the risk mitigation is important, because you can see, well, this is a trigger bar I didn't fill. This is kind of a trigger bar in here. The bar before that is a trigger bar. This is a trigger bar as well. So you can see that you will get multiple trigger bars. It's just the way it happens. And you may say, well, I only want to know the trigger bar that then leads to this move hit. Well, you're just not. You don't know ahead of time. No one has a crystal ball. So it's a game of probabilities, but the trigger bar concept can mean that you can take tight risk control so you can create more asymmetric risk versus reward trades. So sometimes, yeah, you can get knocked out a couple of times. You can kind of get in, free roll it, get knocked out. Sometimes you're just in, you get stopped out. And sometimes it can take 2 times, 3 times, 4 times to actually really get on board with a stock if it's kind of just been wiggling and jiggling and potentially waiting for the right market, the right market environment. So let me then play this forward. A couple more. Let me go to a couple of other good ones here. 1995, you can see Amazon. So this one here, it doesn't always have to be, as I said, it's not always at the base breakout. This is a kind of good one to be talking about. So you see this here, right? It builds kind of like a cup and a handle type pattern is the way I'd look at it. And kind of your classic breakout point is more so here. You kind of get a bit of a trigger bar here. But you see as the stock pulls down to the 50-day, well, it gets supported there with a shakeout demand tail, supported there, and then it puts in this higher low and just starts to tighten, and look how the volume comes through. So a little subtlety here. Again, it's not just what happens, it's where it happens. So you have here a leading stock, okay, 52-week highs, pre-base, really good run. Look at the volume coming through, pulls back down, bounces off the 50-day. So that's just a subtle sign that, okay, institutions potentially in there, if we're seeing the type of things we want to see. Shake out demand tails, gap down, reverse bars. So find support of action on the 50. What do you notice about the volume? There's not much of it. And notice as well how the lower these bars is undercutting the last 4 weeks of lows. It basically undercuts all the base lows. So now you're getting a bounce off the 50-day, low relative volume, undercutting all the base lows. What's that telling you about supply? There's not much. Then it pops, puts in this high low, then you get this really tight low volume bar. It's just a textbook trigger bar. So sometimes you can see them here in the base. So this then means when you start learning about trigger bars, shakeout demand tails, gap down, reverse bars, and imagination for how the stock may play out, how the base may play out. If you're targeting kind of lower pivots within a base, you can go, okay, I could take the trigger bar here. Can I free roll it into the pot? Maybe it sets, puts in a shakeout demand tail a little bit higher. Great. I can try and add to the position as it's basing. And then you're trying to concentrate into what you think are the leading stocks as they start transitioning on a basis. Pretty cool stuff. We'll be learning that in a couple of weeks' time. Let me go through a couple of other ones. I'm going to speed this up a little bit so we can get into the kind of bar by bar stuff. Let me go through. I'm going to jump across to you can just see them everywhere. I'm going to go into the multiple time frame analysis actually. So yeah, let's start with this one here, okay? So this is Dell, relatively recent one, March of 2024. So Dell gaps up on the earnings. I'll spend a couple of minutes, gaps up on the earnings here. Not a great reaction to the earnings, but pulls back down and then builds this kind of cup with a low handle here. What moving average do you notice it gets supported on? Interesting. 21-day EMA pops, and then it puts in this nice tight inside bar. And this is then the subtlety, okay? When we're looking at trigger bars, oftentimes they can resemble kind of little shakeout demand tails or gap down reverse bars. But now we're going to dive a bit deeper in terms of the multiple time frame analysis. So you get this tight bar here. The volume it looks to be the lowest volume bar since the earnings gap. As I said, remember, kind of final piece of the jigsaw indicating there's not a lot of supply around for this stock. That's what we like to see before targeting a trigger bar type entry. And then we want to start looking intraday. Okay, we want to see constructive behavior. This is pretty ideal. Okay, first 1 hour candlestick is when the bigger boys and girls are going to be most active. So what do you think you see in terms of your own mental representations? This is bullish synchronicity. Do you see buying or do you see selling? Do you see accumulation or do you see distribution for this first 1 hour candlestick? What do you see? Well, the prior close is here. It opens pretty much on the low of the bar, little tail on it, and then a strong close on an increase in volume. Okay, this black line is the 30-bar average, whatever time frame we're looking at. So this is the 30-bar average on the 1 hour chart. Looks like buying to me. It's what I'd associate with buying. And then what do you see happens? Well, for the remainder of the session, see how price consolidates in the upper range of the daily range and also above this first 1 hour candlestick, just consolidates in the upper range of that bar. And look how the volume generally dries up for the session. So remember what I said earlier, tightness in price on low relative volume indicates there's absorption of supply or not much supply. So it's a really, really constructive sign to see. So not only when you see, say, a trigger bar, you see behavior like this when you drop it down and you go intraday. Now, this could be that you're on, say, the weekly chart and then you utilize the daily chart in the way that I'm utilizing the daily chart and the 1 hour chart. Okay, let me do a couple of others. I think the multiple time frame analysis is an important point to be getting across. Let's go on to the next one. So we can do pins here. So we looked at this one a little bit earlier on. So we have a positive earnings reaction, and then the stock starts basing like this. Look at the tightness come through. Lowest volume bar, isn't that interesting? Lowest volume bar since the earnings gap, like we just saw on Dell. Isn't it interesting how these things repeat? But then if we start looking at this bar here, okay, so we're looking at this bar and we're breaking it down. I think this was then going into the 3-day weekend. It was like Black Friday or something like that. So we only have a couple of hours trading. Okay, so we're looking at this session in here. But what do you see? Do you see signs of distribution, or do you see signs of accumulation, of absorption of supply? Well, what do you see? First 1 hour, shakeout demand tail. Next 1 hour, shakeout demand tail. That's an inside bar. The next bar is an inside bar, not a great looking bar, but it's another inside bar. And then the final bar is another inside bar. And see how the volume just stair steps down. This is just what a sweet FA in terms of supply and selling coming to the market for this stock looks like. This is textbook. It's absolutely, that's textbook as textbook can basically be, okay? Let's do a couple more. We got AMD. Yeah, so let's do AMD and then we'll probably go into some of the buy stuff. So this is another one that we looked at a little bit earlier on with that gap down reverse bar in the middle of the session. So here's that gap down reversal bar in the middle, okay? And you kind of got this here. It's kind of building this flag type pattern. That's going to be your trigger bar there. Look how the volume dries up nicely. 52-week highs pre-base. You don't get them post-base. You don't get them in the base. That would have been even better. But when we start looking at this trigger bar, this inside bar, okay, when you start breaking this session down, again, it's just creating for yourself, it's creating mental representations of what do you associate certain things with? What do you associate distribution with? What do you associate accumulation, absorption of supply that looks like from an institutional perspective? So this is what you're trying to train yourself to identify on the chart. So a little subtlety here, okay? When we look at the 1 hour chart here and we break down this trigger bar, a useful thing to see is you've got the black line, the blue line, and the purple line. That is going to be the 10 EMA, 21 EMA, and 50 simple period moving average for the 1 hour time frame. I like that. Okay, it's just a reference point for me. What I've experienced and found is often in the better selections, you will have a close convergence of the 10, 21, and 50 period moving averages on the 1 hour time frame when you see a trigger bar forming on the daily chart. On the 10-day EMA or potentially the 21, maybe there's a clustering, maybe the 50 is there. Okay, just this kind of convergence, this clustering of moving averages. Again, it's kind of the point of the stock will move from periods of contraction to expansion. So if you get a close convergence, see how tight all these moving averages are together? When you get that close convergence and the proper and correct context of how the stock is setting up, how it is developing, that is just also indicating, okay, there's contraction here. I'm seeing contraction on the daily chart. I'm seeing contraction on the 1 hour chart. Nice. Now, I'm not saying you need to go down to the 1 minute chart. I spend 90% of my time, daily charts, 1 hour chart. Then when you look intra-session, what bar do you notice marks the low? Do you see it? Shakeout demand tail. So this is where you can take it a step further, utilize the multiple time frame analysis and go, okay, when I then look intra-session, what am I seeing? I'm actually seeing a shakeout demand tail that marks the low. Okay, a little pop up in volume, and then look how price just trades in this tight range on low relative volume for the remainder of the session. What will we associate that with? Tightness and price, low relative volume, absorption of supply, and there's not a lot of supply coming to the market. And we're then seeing this intraday in the context of a leading stock putting in a trigger bar on the 10-day EMA, on the higher time frame in the daily chart. Not bad. Lots of things going for that one. Palo Alto, very similar. Netflix as well. So remember what I said there on AMD about when you look at the 1 hour chart. So here you get a convergence. So this one I traded a couple of years ago now, 2020. It seems like a long time ago, didn't it? So on the daily chart, you have a close convergence of the 10, 21, and 50. And then when you drop it down onto the 1 hour chart, do you see those moving averages? 10 being the black line, 21 being the blue line, and 50 being the purple line there on the 1 hour chart. So the moving averages are different relative to the time frame that you are on, but see the close convergence. So close convergence on the higher time frame being the daily, close convergence on the 1 hour chart, and then just see the tightness that develops. See the tightness, generally the low volume, you get a little bit of a pop in the volume in the last 1 hour, but tightness and price, increase in volume can be absorption of supply. Okay, so really, really, really construct it. And then you can get these explosive moves. Because again, what you are looking to do is, as Toby Corbell said, a brilliant quote, it is highly trained traders that identify this and can identify here is an area on the chart where price can move quite quickly for it because there's not that much supply. So what you're looking for is you're looking for that little equilibrium point. You're looking for that point on the chart where you're like, there's not a lot of supply for this stock. Okay, it's tightening. It's in the proper context. Everything that we've just discussed. You need other traders to be buying after you. You need other traders to be willing to pay a higher price than what you paid. If you are the last trader buying and you buy the highest price, you're going to get stopped out quite shortly. So you need other traders to also see what you see. Okay, it's an important concept. You need other traders to see this. So this is why in a couple of weeks' time, we'll talk about the type of stocks. Again, you'll hear me talk about TMLs, momentum leaders, group theme leaders, and rank them. Tier 1, Tier 2, Tier 3. So if you can go, okay, I think I've just seen a real TML / true market leader type stock, your O'Neill, CanSlim criteria, big earnings, big sales, new product, global product, all of that stuff, right? If you can identify, okay, this is like a tier 1 stock, it's a momentum leader, high 20-day ADR, really liquid stocks, group theme leader is in a really strong area of the market right now. That's probably going to be on a lot of traders' radars. Okay, so it's not just about, okay, yeah, I identified this and it was on a biotech stock that doesn't have any earnings, doesn't have any sales, it's awaiting a FDA approval for a phase 1 trial. They're not going to be profitable for the next 15 years and the market cap is 100 million. Guess what? It's probably not going to be on many people's radar, and it's certainly not going to be on the real big boys' radars because they just can't trade it. There's no liquidity there. So that's where you also need to think about the type of stock that you're trading, which we'll come on to in a couple of weeks. So I think that kind of covers it for trigger bars. Yeah, that covers it for trigger bars. We'll go do some bar by bar stuff, and hopefully it all kind of starts making a little bit more sense. So let me go and press a button here and see that Aman's happy to join in. And if you other guys want to join in as well, let me know, and we'll add a little bit of kind of things in here in terms of trigger bars in the context of different phases of the price cycle. So let me bring in Aman. Hey guys, hope you and families are well. Today's date is the 23rd of April 2024. This is the Blueprint Trading course, whatever it's called. I've forgotten the name of my own course. And this one is going to be about shakeout demand tails. So there are 3 types of setups that I target, which are trigger bars, shakeout demand tails, and gap down reverse bars. So last week we did trigger bars. This is going to be shakeout demand tails. What I want to do in this session is give you a very good insight of shakeout demand tails themselves. So a lot of trading is obviously pattern recognition. So one, being able to recognize them, but it's also the context of where do you see it happening? Are you seeing a leadership in the stock? Understanding the key moving averages to be paying attention to as well. So is it the 10 days? Is it the 21 days? Is it the 50 day? Much is going to depend on the character of the stock. We're going to go a little bit fancy on it as well. We're going to do some multiple time frame analysis a little bit later on towards the kind of lesson part of this video, and then in the bar by bar deliberate practice part as well, we'll be dropping it down. We'll be going on an intra session introduction basis, because then we're really looking at kind of undercuts of base lows underneath key moving averages, having self-awareness of yourself, but also self-awareness of where other traders are trying to position themselves, where they are putting their stop losses. Would they have just been knocked out? Because sometimes when you look on an intraday basis, you can see a really big scary red bar, but that there could actually be a lot of stop losses being triggered, so you get kind of that flush down and then the recovery. So there's a fair few nuances here with these shakeout demand tails. So we'll start going through them. So what I'm going to do is just fast forward ahead, and I want to get to please don't do that to me. It's going to be really annoying if it does that to me. I'm going to have to cancel that. Sorry, bear with me. I don't know why it does that. It just fast forwards when I'm playing, and it's super duper irritating. So anyway, we'll go like this then. Let me get the spotlight tool. Okay, so shakeout demand tails. There's three main ones in terms of actual classic candlestick patterns. That is going to be a hammer type candlestick, a doji dragonfly, and a Takuri line. Thomas Boswolski wrote a very good book, which is the Encyclopedia of Candlestick Charts, where he tested 4.7 million Japanese candlestick combinations. So we can see the database inputs, and he limited at 20,000 database input per Japanese candlestick when he was then doing the data. So we can see with a hammer. So what I just call a shakeout demand tail is a variation of these three candlesticks. So we can see with a hammer, the bull market reversal rate 60%, bear market reversal rate 59%. If we take a look at doji dragonfly, we can see the bull market reversal rate 50%. If we take a look at Takuri line, it's 66% for the bull market reversal rate, and for the bear market reversal rate of 63%. So obviously greater than 50% if you took an average of those. But again, your edge as a trader does not come from your setup or the candlestick. It comes from your risk management, the ability to control risk, mitigate risk, limit risk, and then leave yourself asymmetric upside potential. So that is hopefully then a key that I'm trying to get across in the second half of these videos, where we do the bar by bar part. The 80-20 principle of 80% of your profits are going to come from 20% of your trades is very applicable. So if we take a look here, okay, where I'm then looking in the context of these shakeout demand tails to occur, much like trigger bars that we did last week, is in the context of these common chart patterns. So that's going to be flags, pennants, wedges, triangles, cup and handles, VCPs, Darvis boxes, flat bases, all of that good stuff. But oftentimes the shakeout demand tail is not occurring at the actual breakout point. Okay, it's not occurring here right at the breakout point. Oftentimes it's occurring towards the lows of bases, just underneath those kind of levels. When a high low is forming, we're going to bring in the context of shakeout demand tails on one or more key moving averages as well. So oftentimes you're not going to see these at the actual breakout point. They occur before the breakout point, because for me it's kind of that analogy, if you like, of the sprinter getting into the starting block. So if we just take it forward, so I'll just summarize this in the recording. If you want to pause it, absolutely, then please do pause it. So some of the keys there, as I was saying, we're looking for a strong stock. We're going to talk about leadership. We're going to talk about relative strength, certainly as we progress throughout this course. But we're looking for them to occur in the context of common chart patterns and/or pulling back to one or more key moving averages. Most notable, those moving averages are going to be 21-day EMAs and 50-day simple period moving averages. I'm just going to highlight the controlling risk here. Given the nature of a shakeout demand tail, certainly relative to trigger bars that we were doing last week, where we were talking about, okay, initial stop loss versus the stock's 20-day ADR percentage on the better trigger bar selections can oftentimes be half to 2/3, sometimes even less on that, because a trigger bar is a very tight relative candlestick. And oftentimes with shakeout demand tails is they're a bit wider, as the name implies. They are shaking out. So as kind of a factor of the candlestick and how it forms, it can be that the initial stop loss can sometimes be around the 20-day ADR percentage or 1.5 times the 20-day ADR percentage. For me, I'd like it to still be less than 5%. Anything beginning with like a 4 or 5, I think you've got to really kind of think about it. But sometimes you can get one that is, say, a 20-day ADR percentage on a stock of maybe 6%, 8%, 10%, and the initial stop loss with a shakeout demand tail is 5%. So in that respect, okay, it's still a wider stop loss compared to what I'd normally be going for, but it's still relatively tight given when you then compare it to the stock's 20-day ADR percentage. So obviously a little bit of common sense, but anything over 1.5 times the stock's 20-day ADR percentage, I've really got to think, yeah, this is a pretty darn good stock in terms of how I rank it, which we're going to cover in a couple of weeks time. So I won't spend too much time on that. I'm sure you can kind of read it in the recording. So next 3 slides, I think I'm just going to give you a flavor of the actual trade setup. So this is Broadcon here. I was buying it through the high of this one. So let's bring in the context of, okay, shakeout demand tail. But then the key moving averages for where you are looking for it to occur. So you'll see this blue line on the chart here. This is the 21-day EMA. Now, a lot of stocks that I trade, I try and trade what I deem are the real kind of institutional favored stocks within the market. So these are ones that primarily and most of the time meet the vast majority of William O'Neill's can slim characteristics. Summarize that book. It is big earnings, it's big sales, it's big estimates, it's global products, it's new products, institutional sponsorship. Ideally, the stock is near 52-week highs, all-time highs, is displaying relative strength, as you can see here with the blue dots coming through on the relative strength line. So you can see the earnings reaction seems to be the catalyst to spark the move up, and large relative volume that is persistently high, 52-week highs on the relative strength line. We like it, we like it, we like it. It is a sign that institutions are stepping up there. But if we bring it back to the point of the key moving average, so the key moving averages, it's important to know which one to use as a useful reference point. So for a lot of the true market leader stock, your Broadcoms, your Nvidias of the world, your Ubers of the world that are kind of bigger market cap, 10 billion, 20 billion, 50 billion, 100 billion and above, the 10-day EMA in most cases will be too quick. That's not to say the stock can't just kind of pull in and go off of it, but then it's not really going to be the type of base that I look for, which minimum base duration ideally three or 4 weeks as kind of a reference point there. So what I'm doing is I'm looking for a shakeout demand tail in a leading stock around the 21-day EMA. That is going to be kind of my go-to moving average. However, you can get 50-day moving average shakeout demand tails. You can get clustering to the 10, 21 and the 50, but just here it's important to note that the 10-day EMA is probably for the vast majority of stocks going to be too quick for a lot of the stock. So 21-day is quite a nice sweet spot. So here you can see shakeout demand tail, low relative volume. We'll talk about the volume in a little bit. So for me, what I'm oftentimes doing is using a buy stop limit order, trying to buy it within 0.5% of the prior day's high. If it's a really quick stock, I may increase that. If it's a like slower stock, bigger stock, really liquid, I may decrease that. Again, why would I use a buy stop limit order? Because we'll do this in a couple of weeks' time. It's to help control the risk. Another way to do it would be like an opening range breakout. You see it move through the high, you do an ORB trade. So maybe using the 5-minute or the 15-minute. We'll probably do this later on in the course. And then obviously free rolling levels. But as I said earlier, if you're thinking about the initial stop loss, in this instance here, it's 1.88%, assuming perfect execution. You're very rarely ever going to get perfect execution, but you can see relative to the 20-day ADR percentage is 2.45%. So it's roughly 2/3, a little bit over 2/3, isn't it? So that there is a nice metric. Now, if we take a look here, this is a firm, so I'm targeting it through the high here, cancel the order because it was just a silly thing for me to do, basically, because it gapped up. But anyway, you can see nice reaction to the earnings here, big volume, bullish synchronicity, powers up, and then it builds a cup and handle type pattern. So again, we're looking for cup and handles, VCPs, wedges, Davis boxes, flat bases, all of that good stuff, right? So here you can see, here's your cup. And then here is your handle. Now you'll see that I was just blabbering on about the 21-day EMA being a real sweet spot. And the eagle-eyed viewers may go, that's interesting. He was just saying the blue line 21-day EMA, and that there is on the black line, which is the 10-day EMA. Granted. But you see the stock's 20-day ADR percentage. The stock's 20-day ADR percentage is 6.93% circa at this time here, okay? So 6.93%. So it's a much higher 20-day ADR percentage. If you keep in your head an average for the triple Qs, ebbs and flows around 1%. Sometimes it's a bit more, sometimes it's a little bit below, but if you keep in your head, the average for the major indexes is about 1%. As I said, it can ebb and flow. So what is that telling us? Well, it's telling us that this stock is significantly quicker than the triple Qs. So what it's implying here is, well, if the triple Qs, if the major indexes are going to go up 10%, this stock here, because of the quickness, could go up many multiples of that because of the ADR percentage. It is 6-7 times quicker than the major indexes. And oftentimes it's not linear, that you just go, well, if the triple Qs, it goes up 10% and this stock is 6-7 times quicker, this stock could go up 60-70%. It's not quite that linear. Oftentimes you find it's more exponential in nature. So as you start getting further out on kind of that bell curve of 20-day ADR percentages, what you can find is it's more exponential in nature for how far these really quick stocks want to go. Okay, so that there is just an important concept. So when you have a 20-day ADR percentage and it's 4, 5, 6% territory and greater, I do think the 10-day EMA can be applicable for that stock. But the best thing to do is go back and study the behavior of the stock. So as you're looking for these shakeout demand tails, you're looking for the trigger bars, you start looking for gap down reversal bars, go back and study the character. Go, can you find an example, assuming the stock hasn't IPO'd in the last couple of weeks, can you find an example of where this stock sets and then forms one of these type of candlesticks and then goes off of that moving average? If you can't find a single instant where the stock went off the 10-day EMA, then you may conclude and deduce that 10-day EMA is probably going to be too quick for this stock. But however, I can find 2, 3, 4, 5 examples of where it went off its 20-day or its 50-day. So the character of stocks is going to be really, really important. Let me give you one more. Let me just clear the ink on the slides, and let's go forward one more. So now we're going to go way back in time. I wasn't trading McDonald's in 1984, but the principles here are the same. We'll bring relative strength into this one, as well. So let's just start talking about the relative strength. So here you get more so, for me, it's kind of like a Davis box, okay? The stock is basically going in a sideways manner and building basically a rectangle, which is a flat base Davis box, okay? But there's something interesting here. So this is where we're trying to identify leadership. So again, it's not just a case of at a shakeout demand tail and it's on this moving average or this moving averages or a clustering of moving averages. What we want to try and do is identify it, but in the creme de la creme stocks in the market at any given moment. So how do we do that? How do we mere mortals try and identify the leading stocks in the market? For me, I just default and defer to relative strength. Relative strength is my guide. Why? Relative strength is not my opinion, it's not your opinion, it's the opinion of the market. And the market's opinion is always right. You can try and argue with it, good blimmin' luck with that, basically, okay? So when we're trying to identify leading stocks, my view is the market will not miss the best opportunities. There are too many, just far too many smart operators within the market to miss the best opportunities. And if you go back to the premise, like we did in the price cycle, the large operators, certainly the smarter market operators, they will accumulate positions and they will distribute positions. So in the accumulation, they really take advantage of market corrections. 80 to 90% of kind of your real leading stocks will build their bases during market corrections. So market corrections are very, very, very useful because that is where we get to see the leadership. That is where we get to see, okay, what are the stocks those large operators, those really smart operators are not letting go of easily? What are the ones that are actually taking advantage of the short-term fear? We spoke about the Warren Buffett quote. Be fearful when others are greedy, greedy when others are fearful. When there is fear in the market and kind of retail traders, weak hands, if you want to refer to them like that as well, are fearful and they're exiting, they're distributing their positions. So suppliers coming to the market, the large operators, what stocks are they stepping up and going, thank you very much. Liquidity, perceived value on a short-term basis, we're going to step in here. We're going to continue to build our position. So i.e. when the major indexes are making a series of lower low, lower high, lower low, lower high. Okay, so if I was to draw this for McDonald's, if we were to change this color, and let's maybe just go for like a black line like this or something. So if we see where the relative strength really starts coming through, so okay, the index here may be doing this, and then the index kind of goes sideways, but the index is then doing something like this. Okay, so it's making a lower low. Okay, I'm just going to put L for lower low. So it's making a series of lower lows, and then here it's making a series of lower highs. Definition of a downtrend, right? Lower low, lower high, lower low, lower high, lower low, lower high. I can't press with my hammer in there. That turned out better than I expected. So while the index is doing this, what's McDonald's doing? Well, in this instance here, McDonald's is actually building higher lows. And do you see these 52-week highs on the relative strength line? One of the strongest signs of strength that you can possibly see is a stock that hits 52-week highs pre-base, in the base, and post-base. Pre-base, in the base, post-base. So if we can then look to identify not only a very, very, very strong stock, but it's hitting 52-week highs from a fundamental perspective, also from a technical perspective. And I think a real tip-off here is these little blue dots. It's free tool, search my name on TradingView, you'll be able to find it, right? I think other, maybe like Market Surge or something has it, but I don't think they quite have it just as clean as this. Just blue dots, really simple, but sometimes simplicity is really, really good, right? So these 52-week highs are really good. Why? Because it's telling us as the market action is weak, if I go back to the spotlight tool, as the market action is weak here, low, low, lower high, low, low, lower high. Well, actually, McDonald's is just going, no, I'm just going to hold up here. And if we take a look around the lows, nice reversal on this bar here, fast forward a little bit, shakeout demand tail here, and then another shakeout demand tail here. So shakeout demand tails in and of their own right, in the correct context, and context is very important, are indicative that there is accumulation and there is absorption of supply, and weak hands are being shaken out depending on where it happens. So this is really good action to see. It was really good action in 1984, and in 2024, 40 something years later, it is still really, really good action to see. And it's absolutely timeless, right? If we just clear all these drawings, it's absolutely timeless. This is the thing. Pull up a chart of the Dow Jones on the weekly chart. Now we're going to go a little bit deeper, okay? So you can see the black line is going to be the 10-week SMA, the red line is going to be the 40-week SMA, but pay attention to the lows around basis. I clearly wasn't trading in the 1920s, but if you're understanding things from a supply and demand perspective, it's the same concept. It's institutions that will create the lows, and what we're really trying to do is follow institutional footprints. We're trying to identify when are the institutions active, when do they see enough liquidity, perceived value, what are the stocks they really like? Okay, we dial in, we focus on relative strength. What do we see around the lows? We said on the last slide that shakeout demand tails, and this will be the same with gap down reverse bars, we deduce from it that, well, there's probably accumulation going on. There's absorption of supply going on if seen in the right context. This is where we develop that Bayesian mentality and we update our decision-making process as new information becomes available. So clearly, I wasn't trading in 1927, but it's the same thing. This is a BCP ascending triangle, basically. So you have higher lows, which are structurally bullish. So it starts building higher lows. Volatility contracts from left to right, which is another sign that there is accumulation, absorption of supply, lessening of supply coming through. So again, it's the context here. What is actually happening from a supply and demand perspective? And then in here, you can see back-to-back weeks, shakeout demand tail, a little shakeout demand tail marking the low, shakeout demand tail marking the low, and you're going to learn about these bars over here, which are gap down reverse bars, and another shakeout demand tail, another shakeout demand tail. This would be like a 4-week Darvis box that's building over here. They're really constructive to see in the context of developing races. They've occurred for the last 100 years, and I think as long as we're here, they'll occur for 100 years more. Why? Because it is just the footprint of institutions accumulating positions. That is how I read into it. So what I'm going to do here is go a little bit quicker through these examples, just so you can kind of dial in the pattern recognition. We're going to go in chronological order. So we've got GATEX here in 1973. Again, I wasn't trading in 1973, but this is the point about studying history and just understanding these things are bloody timeless. Like nothing, just nothing has changed. Like the famous book says, nothing new ever happens under the sun, or something like that. Butchered the quote, but you understand what I'm saying, right? So shakeout demand tail on the 10 and 21-day EMA. We go forward to the next slide, CTS, 1975. So you can see 52-week high here, 52-week highs in the base. See that in the base, and then you get this shakeout demand tail to the 10 and the 21, and there is a 52-week high on the shakeout demand tail. You see that? So the stock not only is it putting in a shakeout demand tail and it's hit 52-week highs pre-base in the base, and then it hits a 52-week high on the shakeout demand tail. What's that telling you? It's telling you the market action on that day was very weak, but yet the institutions, the large operators, for whatever reason, went, you like this one. Thank you very much for the short-term liquidity. Perceived value, we're going to step up there. It's a really, really, really good sign. So not every shakeout demand tail, not every setup is created equal. There are a lot of nuances to it. What we'll do here is just talk about this a little bit. So it's the same you're going to see, I think we're going to do it with Apple, which the base duration is very, very similar actually. But this is 1976. When we get into the bar by bar stuff, okay, then I'll show you Apple. But if you take a look here, right, if we were to just draw out the lower this shakeout demand tail, do you see how it undercuts the last 3 weeks worth of price action? See this? So from here to there, right? See how it undercuts it. And what do you notice about the volume? Interesting. It's below the 30-bar average, being the black line. So the intention of a shakeout demand tail, not only is it occurring at the 21-day EMA, it's undercutting the last 2 weeks, 3 weeks of price action. So imagine if you were a trader and you're like, it's tightening nicely. I'm going to buy it in here. I'm going to get positioned in here. I'm going to get positioned here. Where would you place your stop loss? Somewhere in here. What just happened? The low that shakeout demand tail just got you. And what does it tell you about how much supply is there by the big boys in the market? There's not a lot, right? This is just retail traders getting knocked out of their positions now. It's obviously a little bit different, 1976, but the principle is the same, okay? This is large operators just shaking out the weak hands before the move to the upside begins. So it's important that you understand the psychology of what you're seeing and where you are seeing it. Okay, you can see the volume coming through on the up moves. You can see the strength of the rally. You can see the RS line, no 52-week highs, but the RS line is improving. So there's a lot of nuances with it. Let me go back to that one there, go through a couple of others. KEX, shakeout demand tail, low volume. So shakeout demand tails, low volume, undercutting, say, 21-day EMAs, which I said is going to be the real sweet spot in terms of the moving average. The stocks displaying leadership in the market is good. You get shakeout demand tails, undercutting key moving averages, undercutting the last week, 2 weeks, 3 weeks of price action, knock out all of those weak hands. If you don't see a lot of volume, that tells you there ain't that much supply coming to the market. That there can be a very constructive sign. Brilliant. Next month, I'll bring you in the second half when I get through these ones. Another one here, another KEX one. So again, what do you see? Holds the 21, shakeout demand tail. Here's another shakeout demand tail, low volume. Here's another shakeout demand tail, low volume. So then it gives you the opportunity, we'll do it a little bit later on in the bar by bar stuff, to then pyramid into positions. omissions. Okay, so if I was to just draw on this one a little bit, okay, it's kind of one contraction here, two contraction here, start tightening, but it then gives you spots. Okay, can we look to maybe target this bar in here? Can we then free roll into the pop like that? Can we then look to add as the stock then breaks out through the high of this bar here? 1980. It's exactly the same philosophy, exactly same kind of trading tactics. Okay, can we try and position ourselves in a stock, a leading stock as it is basic, taking advantage of trigger bars, shakeout demand tails, gap down reverse bars, and build and concentrate into what do we think are the real leading stocks, whatever they may be. They're obviously the names are going to change. Relative strength, wiggles and jiggles quite a bit. Let's go forward a couple of others. Let me just clear that there. Go get that tool again. So I'll be quicker through these ones. McDonald's, shakeout demand tail. Let me just go through these, okay? So it's just dialing in the pattern recognition. These slides will be available when we finish this course here, but it's just dialing in and actually going, okay, how do stocks tend to base? What do you tend to see before the stock does come out of the base? Like, what do you notice? You may notice different things to me, but I just find it quite peculiar that clearly there's a lot of demand for this stock in 1993 for SkyWest. You can see a really strong move up here. Look at the 52-week highs. This tells us it's a leader. Look at the persistently high volume coming through. What is this? It's demand. Like really good uptrend, a lot of widespread candlesticks moving up quickly, 52-week highs. And then, but what do you see? You're going to learn about this bar here, which is a gap down reverse bar next week. But then do you not find it interesting that the bar before it comes out of the base is a shakeout demand tail? So this stock bases builds this tight little area in here, and then the bar before it comes out of it is then a shakeout demand tail. And don't you then find it interesting that you can see that happen thousands and thousands and thousands of times when you go back and study history and understand what is actually going on there in terms of psychology and in terms of supply and demand? What do you deduce from that? Like, this is what you tend to see. This is what I tend to see. Before a stock comes out of a continuation type pace, it's not uncommon and it's very common to see shakeout demand tails, gap down reverse bars, and trigger bars. So just because you identify it does not mean that that is where your edge comes from. Your edge comes from being able to identify and then create asymmetric risk-versus trading opportunities for yourself. This is why we link back the initial stop loss to the 20-day ADR percentage. We go back, we study the character of stock here. If this stock is going to break out from this type of setup and then trend higher, what is the probable trend? Is it 5%? Is it 10%? Is it 20%? Is it 200%? I don't know. It's a case-by-case basis, and you've got to go and study the stock. So do you think the level of risk that you are taking is asymmetric in nature? i.e. you're trying to risk a proverbial dollar to try and make many, many multiples of that? I'm saying, hey, Jack, how do you differentiate a good shakeout demand tail from a weak one? Hopefully with all the examples that I'm showing you, Mark, and we'll do it in the in the bar by bar bit a little bit later on. Probably take me 10 minutes or so to make it to that bit. Let me just clear these drawings, go get this one again. So let me just go through these a little bit quicker. Okay, not Palo Alto, I think Palo Alto, Pantheon Resources, UK stock. You won't just see it on US stocks, it's UK stocks, Indian stocks, cryptocurrencies, as we're going to do. It's everything. It's commodities, it is everything. It's supply and demand is what you're seeing in front of you. The gas as well. So what I want to do here is just go into let's do this one here, actually. This will be a useful example. So we'll do this in the bar by bar a little bit, okay? We're now doing multiple time frame analysis. This is where we add some complexity into this, okay? So what we have here is we have Disney, okay? There's an earnings gap up on this bar here, which says good earnings reaction. That's a very good earnings reaction, right? You have really good volume coming through. You have a big improvement in the relative strength, and then the stock pulls down and you get this shakeout demand tail. Okay, so we're looking at this shakeout demand tail here. Nearly point to the wrong bar. But this shakeout demand tail here. Now, interestingly, where does it undercut on the chart? Where do you see that it undercuts? That's interesting. It undercuts the low of the earnings gap. Now, there are a lot of market operators, including large operators, retail traders, that will buy earnings gap ups. Okay, buyable gap up is one thing taught in the O'Neill Disciples book as well. But it's common, right? Earnings gap up, people buy it. They may do like an ORB on it. So they buy the 5-minute breakout, sometimes the 1-minute breakout, but the 5-minute, the 15-minute, or the 1-hour breakout, okay? And where do they tend to put their stop loss? Do you know where they tend to put their stop loss? So this is where we start diving more so into the psychology, okay? Psychology of you, awareness of yourself, but awareness of other market participants. So as we look on a chart, we're trying to bring it to life. We're trying to be aware of other market participants. What are they likely to be doing? Where are they putting their stop losses? And then following the footprints of the institutions, knocking them out, okay? The belief that I have is leading stocks are trying to go higher under the right market conditions, but they're trying to do it with the fewest amount of market participants on board, okay? Large operators, they are very, very greedy. They are not your friends in this instance. So a lot of traders, okay, a lot of market operators will put their stop loss right here, just underneath the low of the earnings gap. So where does the low of this shakeout demand tail go? Interesting. It undercuts the low, the earnings gap. You got it. There's going to be a lot of stop loss orders there. So what we're doing is we're looking at this action here. Okay, this session here. Now, what do you notice for the first 1 hour bar? You see this big red bar here. So sometimes when you drop it down and you look on an intraday basis, so here we've obviously got the daily chart on the 1 hour chart. Let me I can't just drew over that shakeout tomato, didn't I? I'm trying to learn these things. But you see this first 1 hour candlestick. Sometimes when you go intraday, it can look pretty terrible. Right? You look at it intraday and you're like, wow, there's a really scary red bar there, and look how the volume increased as well. That's looking terrible. Now I'm just pointing with this one. It's looking terrible, isn't it? Yeah. At that moment in time, it is looking terrible. I completely agree with you. There's no trade to be had there for me. But by the end of the session, it doesn't look terrible. There's that Bayesian mentality. You update your decision-making process as new information becomes available. So who was getting stopped out here? So sometimes you can see this really scary red bar. But then if you see the shakeout demand tail and you're aware of the context on the higher time frame, you're like, well, it's just undercut the 21. A lot of traders are going to use that as a stop loss. It's just undercut the low of the earnings gap. It's just undercut the low of the last 4 weeks, 3 weeks, 2 weeks as this stock has been basing. A lot of traders are going to place their stop losses there. So as you're looking at the chart and you see the shakeout demand tail form, okay, and thereafter you see it form as well, if you then target it, say the next session for a break of the high, ask yourself, who's maybe getting stopped out there? A lot of traders look at the developing base, look at the context of it, earnings gap here, and think who is maybe getting stopped out there. Here, when you then see that big, scary 1 hour bar, it makes sense, does it not? That you like, well, a lot of traders would have placed their stop losses just here, just underneath the low of that earnings gap. So they're getting stopped out right here. So what you have right here is you have an increase in supply over demand, because price is going through this level where a lot of stop loss orders are going to be. So what do you think is going to happen if you have your scales of supply and demand and suddenly you have a lot more supply that is coming to the market relative to the demand? Okay, your scales are going to do that, meaning price is going to go down. So it's very reasonable and logical to expect price to really flush down right there, because a lot of stops are being hit and there's not the buying to come in and absorb the stop loss orders being hit there and the supply being hit. And traders intraday looking at it and like, wow, this looks absolutely terrible. It's undercutting the earnings gap. Look, I'm out. So some will use hard stops, some will use mental stops. But this bar here looks absolutely terrible intraday, but it doesn't buy the close. And that's the Bayesian mentality. Okay, you're never rigid, you never fix, you just update. New information becomes available, great. I just feed that into my process. What do I want to do with it? How do I want to respond? How do I want to react? How am I going to adapt to this? And then by the close, what do you see? Well, there's no persistency of any supply, and then a nice rally, and that proverbial marathon runner is right there near the high of the day, ready to go. So this is where we really bring in the psychology. I think we can spend a lot of time on this in terms of the bar by bar. So just being aware of you and other market operators and where they may be placing their stop losses. So Uber here, for instance, I'll just do this one and then we'll go into the bar by bar, as I've got some interesting ones lined up. So I just want to talk about Uber here, okay? So Uber, I was buying through the high of this shakeout demand tail and bought it here as well. Sometimes they work, sometimes they don't work. It is what it is with trading. It's called variance. So let me try and draw this in a nice straight line for you. So with Uber here, okay, Uber breaks out and you get this bar here. So we call this bar a supply shoot, and it happens at the logical time, right? Price is running up. It is very V-shaped in nature. You will not see me chasing these V-shaped breakouts. I don't go anywhere near them, okay? So this right here is just moving through the high of the base like that, okay? Traders, retail traders, probably jumping in, buying it there. You can tell because there's sweet FA in terms of the volume. But then what's interesting, okay, is you then have a big shakeout demand tail 2 sessions later. So we now just dial it in and look at the shakeout demand tail. So this here is going to be that V-shaped breakout that I was talking about, okay, is right here. There's the breakout through the base highs. This bar right here, okay, I'll just circle the volume for you and I'll circle the top of the bar, okay? Retail traders jumping in through the base highs, V-shaped in nature like that, and by V-shaped breakouts. And then where are they going to place their stop losses? Where do you think? Yeah, if you were buying that there, well, maybe you put your stop loss just in here, which is going to be, say, this level in here. So then on that shakeout demand tail, what's happening? This. Well, isn't that bar telling us, well, hang on a minute, it's a bearish change character. There's a lot of supply coming to the market. This doesn't look right. Institutions are exiting their positions. We miss the context of breakout, shakeout, then it reverses and goes. So you've got to be aware of who's doing what where. and waiting for shakeout demand tails to at least occur on 10-day EMAs, if not 21-day EMAs, but being aware that there's going to be some games around some very obvious points on the chart, such as breakouts for a base high, okay? You just draw a line across the base high, and if it's V-shaped like that, you can have retail traders who are just chasing it up there and just buying it up there. The stock's breaking out, I've got to chase it. I got told in the book to buy that breakout. It's the context, right? Most of the best breakouts do not come at the breakout point. The breakout point is not a very good place to be buying because it's really, really obvious. Okay, so you got to be a little bit more subtle. Okay, you got to be trying to tape read it a little bit, get a feel for what's going on from a supply and demand perspective. Is this stock a leading stock? Uber certainly looks like a leading stock. 52-week highs all over the place. Okay, targeting it down there, that region between 10-day, 21-day, the 21 and the 50-day, first retest of the 50-day, that kind of zone in there. Okay, pops up. Remember, we do this then in the trade management. Pop, test, reversal. So here is the pop. There's the test. Then it reverses. And then what you're trying to do is go, okay, are the institutions on my side here? When you get this shakeout demand tail on the daily chart, well, it looks like institutions are on your side, does it not? They're shaking out the weak hands. So seeing these shakeout demand tails can be a very good sign that institutions are up there, up to their usual games. Sometimes they're pretty subtle, but if you can try and bring that chart to life, really try and tell yourself the story of who's doing what where, specifically the institutions, what are they up to, try and follow their footprint. These things are absolutely timeless. So shakeout demand tails, for me, really good indication under the proper context that there is accumulation, absorption of supply, and the large operators, they are up to their usual tricks. So let's clear all that. Hopefully it showed up all right on the thing. I can exit the annotations tool now. We can go and do this one here like that. Okay, so let me bring in Aman as he's happy to join in. So let's bring in Aman. Hey guys, welcome to the Blueprint trading course. This is a video for section 1, identify, and then at 1.3, gap down reversals. There was a problem with the Zoom recording, i.e. it didn't actually record, so I'm refilming this section of the video for you. So this one is going to be all about gap down reversal bars, which is the last of 3 type of setups I look for. So we've done trigger bars, we've done shakeout demand tails, and now we are on to gap down reversal bars. So let me fast forward to the section. So we're going to go down here, and it's going to be this one here. So gap down reverse bars, let me get the laser pointer loaded up for you. So gap down reversal bars, these are variations of gap down reversal bar Japanese candlesticks that I look for. So this data is from Thomas Corsellis' book, the Encyclopedia of Candlestick Charts. So gap down reversal bars take the form, in essence they can wiggle and jiggle, look slightly different, but of these Japanese candlestick patterns. That's a piercing pattern, a belt hold bullish, and I'll really explain the psychology behind a gap down reversal bar with a belt hold bullish, meeting lines bullish, thrusting, and then a bullish engulfing candlestick, which you may be familiar with. So it's good to know the reversal rates as well. So with a bullish engulfing candlestick, there were 20,000 database inputs, bull market reversal rate 63%, bear market reversal rate 62%. But what I want to do is explain the psychology here a little bit of a belt hold bullish for a gap down reversal bar. So it's not just, okay, the Japanese candlestick pattern forms and it's a belt hold bullish or a bullish engulfing candlestick. It's not just what happens, it's where it happens and how the chart is developing. Is it a belt hold bullish that gaps down onto the 21-day EMA, bounces perfectly off of it and undercuts the last 3 weeks of lows, and that's a logical place to take out a load of stop loss orders. So it's the context of where do you see it on the chart. Was the stock displaying relative strength? Is it a real leader? Next week we're going to go into the type of stock. So if you think about a belt hold bullish here, and we just go into the psychology. If I go and get a pen here so I can doodle on it. So if you think about a belt hold bullish, okay, the last closing price is here on the daily chart. So the last closing price is here on the daily chart, and price gaps down. So price gaps down here and opens here. Now, the thing with a belt hold bullish is the reversal rate very high. Bull market and bear market reversal rates are 71% from about 14,500 database inputs in Thomas Corsellis' Encyclopedia of Candlestick books, where he tested 4.7 million different Japanese candlestick combinations. But if you think about the psychology here, the prior closes up here, so it gaps down. So in the pre-market, it's looking terrible. This thing is gapped down, but what does it tell you? Well, it tells you that there were enough buy orders that just stepped up immediately as soon soon as this stock opened, there is immediate presence of demand, enough in which that the sell orders could be overpowered, and then this stock just rallies. So if you think about why the reversal rate is so high, being 71%, which is one of the highest reversal rates of a Japanese candlestick that you're going to see in terms of this course, if you think about it, it's a really good indication that there's a lot of strength. Why? Because prices gap down, it's opened on the low of the bar, and then it's immediately just turned around with a strong close. So that there is an ideal candlestick if, for a gap down reverse bar, if it's in the correct context. So it can tell us there is the presence of demand, and subject to where it's happening and what the price action, what the volume is, the location of it, we can deduce from that potentially that that looks like large operators up to their usual game. So let me clear the ink there. Let me go get my laser pointer back, and let me go forward a couple of slides. So with a gap down reversal bar, okay, similar with a trigger bar and a shakeout demand tail, it's quite rare to get one here at the actual breakout point. Okay, it's quite rare to actually get it there. With a gap down reverse bar, similar location to shakeout demand tails that we did last week, it's more common to get them here, to get them here, to get them here, to get them here. Because if you think about it, institutions are the ones that create the lows. So as institutions, certainly in your more TML type stocks, when they see enough liquidity and perceived value, that is when I'm looking for them to step up in the right location and start seeing the footprints. You'll hear me talk about the footprints a lot, and up to their usual games. These are the usual games. Shakeout demand tails, gap down reverse bars off 21-day EMAs, 50 days, potentially 10-day if it's a really quick stock. Maybe it's one in here, maybe it's one in here. So very rare, or much rarer, that it actually happens here, that you get that candlestick forming there. More so, it's just before that. So it's a common characteristic that you tend to see before a stock breaks out of a base. Like it's just getting ready. It's getting into position. Let me take you through a couple of others. Let's go back to the laser pointer. So I'll let you pause the video and read this. I'm just going to cover the controlling of risk section. So the inherent nature of a gap down reversal bar is it's a wider candlestick. You saw like the piercing pattern, the belt hold bullish, the bullish engulfing candlestick. They are, given their nature, wider candlesticks. So that's important to understand because it's going to feed in to the controlling risk component of a trade, right? So they're not going to be as tight, the bars, as say trigger bars, which are often tight, low volume inside bars. They don't have to be inside bars, but tight bars, low volume. So same with a shakeout demand tail, same with a gap down reverse bar. The way I think about it is ideally I'd like it less than the 20-day ADR percentage, but within 1.5 times of the 20-day ADR percentage, I think it's acceptable if it's a real kind of powerhouse leader and I really like the setup. So it's like the institutional TML type stock, and it's just it's hitting 52-week highs on the relative strength line all over the place. Then it puts in a gap down reverse bar off the 21-day EMA, and it looks like it's building, say, like a flag or some common continuation type pattern. I'll be thinking about it. If my initial stop loss starts going over a 4 or 5%, I got to think this is a really good setup. So I'll let you pause the video and you can read the rest of that section rather than me read for 5 minutes too. So in terms of things to be looking for, so not every setup is created equal. There's a couple of subtleties to be looking for. Ideally, you'd like to see the stock in the context of a really nice uptrend. So above all the key moving averages, hitting 52-week highs. You can see that on the relative strength line. 52-week highs actually hits 52-week highs whilst it's in the base. So ideally, we'd like to see 52-week highs pre-base, and then 52-week highs in the base is a really good sign of strength, and then 52-week highs post-base, say on the breakout bar itself, or like the entry candlestick itself, which would be this bar right here. Even better if it hits a 52-week high. This one doesn't. It hits it the next day then on the entry bar. But this one here, if it hits a 52-week high on the gap down reverse bar or the trigger bar of the shakeout demand tail, for me, I think that is a very strong sign of strength. So we'd like to see the stock in a powerful uptrend, hit 52-week highs, trending above, and then we're looking for those continuation type bases to build, and the stock to do certain things around certain moving averages. So this right here would have been a gap down reverse bar, but it wouldn't have worked. If you were targeting it through the high here, you then would have been stopped out here. So they all work. They don't all work. And that's why your edge is not from the setup. Your edge comes from your risk management and being able to control risk over a large series of trades. But then you get another gap down reversal bar here. So see how the prior close is here. So it gaps down, opens on the low of the bar, and then pushes up and immediately turns around. And it's undercutting the 21-day EMA. The relative strength line actually ticks up a little bit on that session, indicating the market was potentially a little bit weak. But the fact that it gaps down, opens on the low, turns around and push up is a really good sign of strength. And you can see the catalyst that seemed to spark this rally here good gap up, good volume coming through, 52-week high on the relative strength line. This stock at this moment in time is a leader. Let me clear the ink on the slides. Let's go to the next one. So same here, you can see nice uptrend, see the 52-week highs. That's what we want to see. Powerful uptrend above all the moving averages, not chopping around all over the place. Okay, you don't want it chopping around all over the place. You want a nice uptrend, and then it starts basing. Ideally, the stock finds supportive action around 10 days, 21 days, 50 days. The 10-day being the black line for the vast majority of stocks is going to be too quick, especially if the stock has a slower ADR percentage. Like anything sub 3, the 10-day EMA is probably going to be too quick for that stock. But here you get a gap down reverse bar, bullish engulfing candlestick, and then you get another bullish engulfing candlestick. See how it opens on the low, goes out on the high. The stronger or the closer the closing price to the higher the bar for trigger bars, for shakeout demand tails, for gap down reverse bars is a little subtlety about the strength. It's a better sign of strength. You think about that. Okay, the stronger the stock can close, the better indication of strength. That's how I interpret it. NRG as well, we're in 2004, see the uptrend. So I just want to emphasize this point. Okay, it's a subtle point but an important point. This uptrend here, see it? Nice uptrend just above the 10. It's not doing this. It's not like this. And then I'm singing. It's not doing that. Okay, that behavior is going to be a nightmare from a trade management standpoint. Remember, it's about trying to understand the character of the stock. You want a smooth trend pre-base, you want a constructive trend or a constructive base, and then we're expecting, because of the character of the stock, it's a smooth mover. It likes to stay above this moving average, that moving average, that moving average. Potentially when it trends, we're expecting that to play out in the fourth component of a trade, which is the optimization of profits. Okay, so we're trying to get a feel for the character. But you see here how the stock is kind of setting a little bit higher, and then gap down reverse bar, gaps down, opens on the 21, a little shakeout demand tail, and then it pushes up, closes strong, and then breaks out. And they're obviously the free roll targets. But I would go stop. I would target it by stop limit order. You could do an opening range breakout through the high like that. It's something to be considering, and then stop loss underneath the low of the day, and then thinking about the initial stop. 2.76% off an ADR of 2.4%. Okay, it's within that 1.5% territory that we were talking about, and then it hits a 52-week high in the base, hits it post-base, it's hitting it pre-base. Strong stock. Let's go and do another one. Let's erase all of that ink there. Go get my laser pointer back. There we go. Okay, Nvidia as well. So if you think about Nvidia, it's building this cup and handle type pattern, obviously institutional stock, but then it puts in this gap down reverse bar. There's a bullish engulfing candlestick, but see how it gaps down onto the 21-day EMA, bounces perfectly off of it. Okay, so it's the location of where does this happen. This is Hilton, Jan 2024, gap down reverse bar, gap down reverse bar, gap down reverse bar. There's also an inside bar, so you can get trigger bars that look like gap down reverse bars. You can get trigger bars that look like shakeout demand tails if they're tighter. Initial stop 0.9% off a ADR of 1.6%, very favorable risk versus reward. Okay, and this one here is building more so a like Davis box, little Davis box cup and hand, more of a Davis box for me. Okay, but they're constructive signs also in the context of when the stock is trending up. Constructive signs. Now this is the Dow Jones. This is nearly 100 years ago now. We're looking at the period of 1925, 26 and 27. So let's go get the pen here. So this builds an ascending triangle, which is also a VCP, where you get these contractions and they're building higher lows. The depth of the contractions is roughly halving each time. So you'd have one contraction here, you have two contractions here, you'd have three contractions here, you'd have four contractions here. Okay, it's institutions in the 1920s and in 2024 that create the lows of the bases when they see enough liquidity and perceived value. So what I like looking for is when a base is developing, I like looking around the lows. Am I seeing gap down reversal bar? Am I seeing gap down reversal bar? Am I seeing shakeout demand tails? Am I seeing shakeout demand tail, shakeout demand tails, trigger bars? There's another gap down reverse bar, gap down reverse bar here, gap down reverse bar. This is basically like a little Davis box, but see how you get a shakeout demand tail, gap down reverse bar, shakeout demand tail. Here, look, it's a gap down reverse bar. This is actually a gap down reverse bar and a shakeout demand tail. So it's really constructive sign. This here is a shakeout demand tail. So you just start seeing them everywhere, right? This is a gap down reverse bar, gap down reverse bar, as it's building this continuation type base. So I love looking around the lows, okay, around bases. Okay, what do I think institutions are doing? I kind of like make it a game, like I gamify it. I'm like, okay, what are the institutions doing? Am I seeing their footprints? Am I not seeing their footprints? Like, kind of just make it a big game basically. Trying to follow the footprints, but it's really constructive science. Why? Because it is just it's the basic law of supply and demand. It is evidence for me. If you see a gap down reverse bar, you see a shakeout demand tail in the right context, it can be evidence that there is absorption of supply, there is accumulation going on. That's all that happens in the stock market. Supply and demand, accumulation, distribution. That's all that happens. Now if we go through to a couple of other ones, I'm going to talk a little bit about AMD here. So I'm going to show you AMD from 1992. I'm then going to show you AMD from 2019. And we're going to look at the gap down reverse bars. Then we're going to do some multiple time frame analysis. So let's go back to AMD. This slide deck will be available when we finish the course. So let's start drawing on this a little bit. Okay. So AMD is in the context of a nice uptrend, stays generally above its 10-day EMA, no 52-week highs, but the relative strength line generally is trending up quite nicely. Okay, we like that. There's a few kind of pops in the volume, so AMD builds this continuation type base. It's a little kind of gap down reversal bar in there, nice breakout coming through right on this bar here. But then it's this space that we're looking at, and I'm going to just draw a straight line as I possibly can, something like that. Okay, so there's a couple of bars to note, right? What bar is this one here? You see it? Shakeout demand tail, right? Just draw this SDT. Shakeout demand tail onto what moving average? In the region of the purple line, which is 50-day simple period moving average. Okay, interesting. Big pop in the volume. And remember, when this bar was on the lows of the session, when it was down here on the lows, it looked horrendous. It looked like a mega change character. But this is the point about building that Bayesian mentality. You update your decision-making process when new information becomes available. Then what happens? Well, it's another shakeout demand tail onto the 50-day, and it puts in a HL, a higher low, and it's another shakeout demand tail. Okay, so we're looking around the lows of bases, right? We're trying to get a feel for this stock. Okay, what do we think institutions are doing? Do we think they're accumulating? Do they not think they're accumulating? Then look at the strength here. Okay, I call this bullish synchronicity. I'm just going to put BUS, bus. Bullish synchronicity coming through here. See how it pops back up through, reclaims the 10 and the 21. But you have shakeout demand tail, bullish synchronicity, and then the stock kind of tightens. Okay, in this range here, kind of tightens, and then you have this breakout. Still pretty V-shaped in nature for me. See how it kind of comes down, very V-shaped. I don't think it's really had time. Yes, it's an inside bar, and the volume dries up, but it's pretty V-shaped in nature. Short term, extended from the 10-day. See that? Extended from the 10-day. So this is going to be your breakout. Okay, breakout up here. Now take a look at the volume on the breakout. Did it look like large operators really kind of piling into it, like we saw them do on this bar here, like we saw them do on this bar here? Not really. Who do we think is buying up there? Retail traders. If you are buying this breakout right here, so this is where we start to go in the self-awareness of things. And when you're looking at a chart, you're trying to understand the psychology of the chart. Who's doing what? Who's buying and selling what? Where are the retail traders buying? Where are the different types of retail traders buying? Where are the institutions buying? Do we see their footprint? We see their footprint because of the size that they trade. Okay, there's subtleties, there's nuances, there's ways in which they play the game, and we're trying to identify the ways in which they play the game. Okay, what are they doing? They're doing this, they're doing that. So if you were buying this breakout, where would you place your stop loss? Just underneath the low of this bar, underneath the low of this bar, or just underneath maybe the low of that bar? Somewhere in that region, right? What bar knocked you out? You got it. It's this bar. Gap, down, reversal. This is just the belief that I have. Leading stocks are trying to go higher, but they're trying to do it with the fewest amount of market participants on board. Large operators are greedy. Okay, they're greedy. They ain't your friend. They're trying to shake you out. So this is where you learn the games that they are up to. You learn how they play the game. So gap down, reverse bar. But what's quite interesting about the gap down, reverse bar? Well, it gaps down. Pretty significant gap down. It goes from, what would that be, about $9.20 to $8.50. That's a pretty sizable gap down in terms of percentages for this stock. Right, so it's gapping down. The prior close is up here, it gaps down, and where does it open? Right there on the low, and it gaps down below the 10, below the 21. But here's the kicker: it opens on the low of the bar. See that? Opens right on the low of the bar, pushes up and reverses, and the volume pops as well. Okay, interesting. So think about this. This, as we expect, because of breakout traders buying here, a bunch of stop losses places there, panicking out a load of weak hands because it's gapping down. It's going to look horrendous in the pre-market, gaps down below the 10, below the 21. we're expecting what? We're expecting a lot of supply to come to the market when this stock opens because of panicky weak hands going, oh, let's get that out, stop losses being triggered. But the fact that it's able to just open on the low of the bar and reverse immediately tells you what about the presence of demand. Two things. Number one, there's a lot of it. And number two, it was immediate. As soon as the stock opened, boom, turn it around. Then it sets. This is then kind of like a trigger bar. Then it builds another pivot and then goes here. This is what Davis recognized in, so he changed his rules in, I think, 1970s or 1960s. He changed his rule from, he wouldn't buy the first breakout from his Davis box. Okay, he wouldn't buy the first breakout. He would buy the second breakout. Because what he noticed, okay, there's the second breakout, this is the first breakout. Because what he noticed, so he updated his rules from how he made 2 million in the stock market. He updated his rules because he was noticing this a lot. Breakout, fake out, right? So he updated his rules. He went, I'm not buying the first one, I'm buying the second one. Because he was like, I kept getting shaken out on the first one, so I decided to buy the second one. See the psychology? Let me delete that ink. Then I'm just going to go doodle over one more. So let me just play it forward. Okay, so now we'll go for AMD. 20-something years later, 25 years later, or say 27 years later. So this one here, AMD, right? See the quality of this uptrend. See how it stays above the 10-day EMA. Really nice uptrend. 52-week highs, post-earnings as well, 52-week highs. Obviously, AMD, we know, institutional stock. You can see the volume that's been traded for the stock. You can work out the dollar volume as well. Okay, persistently high volume, multiple days above the 30-bar average, which is the black line, right? Multiple days, presence of institutions. And what's the stock doing? It's trending and hitting 52-week highs. They want it, okay? And then you get this gap down reverse bar. Okay, so it's this bar here. So see how it gaps down and the open is pretty much the low, and then it turns around, reverses, pushes higher, and has a good close. Now imagine how terrible this looks on the open and when it just sells off briefly, maybe the first couple of minutes, okay? It looks terrible. It's down here. It's below the 10, below the 21. It looks like a change of character. Think about where a load of stop loss orders are going to be. Maybe in here, maybe in here. A lot of traders will use below the 21. Yeah, I'm out of it. It's below the 21. And then what happens by the close? Oopsie daisy, turns around, reverses. But then what do you notice? This is a pretty scary looking bar. It's a pretty significant decline as well. Kind of get a little bit of a damaged trend channel there too. But what do you notice about the volume? Interesting. The pullback is below the 30-bar average, and the gap down reversal bar is also below the 30-bar average. What does that tell you about supply selling at those levels? There ain't much of it. Good to see. Good to see. So not only do you have the presence of large operators there, you also, because of the volume deducing, there ain't that much selling. There ain't that much supply there. Even though probably a load of panicky weak hands are selling, a lot of stop losses are getting triggered. It's good. Now maybe the risk makes sense on that GDR, or maybe it sets as AMD did, and then you get textbook trigger bar. But this is why then when you're looking at the textbook trigger bar, you've got to be aware of what happened around about a week ago, week and a half ago. Nice gap down reverse bar, and then look how the volume just stays low. Very little relative supply for this stock. So what you want to see, that easy 9 out of 10. Easy 9 out of 10 setup. It's ridiculously good setup in my view. So let me take you through a little bit of multiple time frame analysis to conclude this session. We obviously do this a lot in the live coaching session. So let's just finish with a little bit of multiple time frame analysis. So let's do we could do we got do Carvana. I'll do two actually. I'll do more of kind of a classic one, something like this. Okay, let me do, this is AT. So the stock is Chinese stock at the time, or it still is a Chinese stock I believe, but it is showing a lot of relative strength from its IPO. This is where Chinese stocks were showing a lot of relative strength. So you can see all the 52-week highs, right? And then what we're doing is it's actually back-to-back gap down reversal bars. So do you see this one here? Off the 21-day EMA. So perfectly off the 21-day EMA, and the first 1 hour candlestick is right there. Okay, a little gap down reverse bar. So the prior close here, gaps down, opens there. See how it opens on the lower the bar and then just pushes up and reverses. There is immediate presence of demand. Really good to see. And then the volume drops, and then we get another gap down reversal bar. So we're then specifically looking at that bar there, which is also then like a trigger bar. So it's like trigger bar-esque and a gap down reverse bar. But what happens? Well, the prior closes here, gaps down, opens on the lower of the bar, pushes up, and then consolidates in the upper range. And then you'll notice on the 1 hour chart, the black, the blue, and the purple. That for me is the 10 EMA, the 21 EMA on the 1 hour chart, and then the 50 simple period moving average on the 1 hour chart as well. You'll notice oftentimes with the better trigger bars, gap down reverse bars, and shakeout demand tails on the daily chart, that when you drop it onto the 1 hour chart, those moving averages are in close proximity to the price and they have converged. Okay, they have converged. So I think it's pretty constructive action to be seeing. And then the volume just stays below the 30-bar average for the remainder of the session. This is really good to see. So this is kind of like back-to-back gap down reverse bars, but then it's the tightness, it's understanding what is happening on that session there from a supply and demand perspective. It is very, very good behavior to see. And then we'll finish off with one final one, and we will go for a Carvana. So this one that I was targeting through here, and again, this one's going to be a bit different because it's not kind of your standard one, so it's good to kind of talk about this one. But Carvana, really good rally here. You got to understand the stocks as well. So high ADR percentage, highly shorted stock. It oftentimes has a short interest of 30%, even into the 40% at time. And then you can see the volume pops, right? Volume pop, volume pop, volume pop, volume pop. Good rally. And then look how the volume just declines as the stock is pulling back in. Hits a 52-week high. Okay, the RS declines, but you'd kind of expect that. Then what I've got is, I'm kind of looking for the signs. Okay, as the stock comes back down, what chart pattern could form? Is it going to turn into a cup and handle type pattern? This could kind of round out and it turns out to be the bottom of like a cup, and then it goes and builds like a handle a bit higher and then breaks out of the handle. Maybe it does, maybe it doesn't. I'll just employ that Bayesian mentality. But as the stock is pulling back, I'm looking around the lows, right? Okay, if I maybe go and get maybe the highlighter is going to be better. Okay, I'm looking in here. Look at this. Gap down reverse bars, shake out demand tail, shake out demand tail, shake out demand tail. Then we start getting down to the 50. What do you see? Well, there's a gap down reverse bar, another gap down reverse bar, shake out demand tail. Okay, stock rallies, pulls over. Okay, there's a bit of demand coming through in here, but then in this region here, right? These collection of candlesticks, what happens? Well, what you get is you get one bar. This one here is a shakeout demand tail. I'm just going to put S for shakeout demand tail. You then get another one, which is I'm just going to put G for gap down reverse bar, and then obviously the final one is also a gap down reversal bar. So if we start looking at the prior session, so we've got like G1 and then G2, right? So this is going to be 1, this is going to be 2 when we break it down onto the 1 hour chart. Note the proximity of the 10, the 21, and the 50. They're right there. Interesting, right? But here you get the prior close. So G1, prior close of the session is there. Gap down, open here, shake out demand tail, pushes up. Tight, tight, tight during the session. Good rally, and then pretty tight to close out with that inside bar. Okay, interesting. So the prior close here, gaps down, opens here, shake out demand tail, pushes up, recovers, bullish bar. Okay, supply shoot, tries to go, pulls back into a clustering of those moving averages, good rally, and then that bar there. Tight little inside bar to close out the session, and look how the volume just dried up. Really constructive. Now I use the analogy of a marathon runner just to conclude the marathon runner, right? If you're going to run a marathon, where would you like to start? As close to the starting line as possible. Why would you like to do that? Because you want to expend the least amount of energy getting to the starting line. Okay? You want to use all of your energy running the race. That's why the close of shakeout demand tails, gap down reverse bars, trigger bars, it's better if they close right on the high of the session or very close to it. Why? Because you want all the buying power, which we're anticipating to come through the high of these bars, because you need other traders to be willing to pay a higher price than you to push the price higher. You want all of that buying power to be pushing the share price higher, giving you a profit on your position in which you can first and foremost and mitigate the risk. And then we'll go into the optimizing profits. But we want all of that buying power that comes in when the stock is closed pretty high, pretty close to the high of the session. It just powers through like that. Just powers through. It's really, really constructive action. So hopefully that there gives you a really good flavor of gap down reverse bars. So we've done the 3 entry candlesticks I look for: trigger bars, shake out demand tails, gap down reverse bars. And then I think in the next week we're going to go on to the type of stocks. So there's certain type of stocks that I look to trade. So you're going to learn about true market leaders, you're going to learn about momentum leaders, and you're going to learn about group theme leaders as well, and how to identify them. And then that obviously feeds into your scanning. So for me, my scanning is specifically then designed to find these type of setups in certain type of stocks. So thank you very much for watching. Hopefully you're enjoying the course. Apologies that there was a problem with the Zoom recording in the live webinar, but hopefully this pre-recorded video was useful for you to learn about gap down reversal bars.